right, welcome back everyone to this week's live stream. All right, so we got a lot to get into. I think every single week so far for the past month or so, there's been new updates going along, new things to talk about. So may you live in interesting times, as they say. So yeah, as always, look at the description below and you can get an idea of what we're going to be talking about. We don't have to spend exactly that amount of time on everything. I can make adjustments. As always, on a go forward basis, like as we pass through the show, you can always ask me questions about things we've already talked about, and I'll address them then and then, or then and now. And stuff that's asking about themes we're going to be talking about later, I will star them and we'll answer them later. If you're curious of what the sponsors are, they're down in the description below, physical.ai, as well as myself, Capital Mindset, and the Capital Mindset community. And yeah, with that being said, everything I say in this show is my opinion alone, does not reflect the opinions of Fraxinus. Okay, so let's get started. Markets today hit a new high, or are returning to highs, I should say. And what people are asking, of course, is like, okay, well, is this too soon? Is this, the rise before the fall, so to speak? We'll talk about relative positioning, how people are feeling about that. We'll talk about where funds seem to be positioned. And before we get into all that stuff, though, we got to talk about the elephant in the room, which is, of course, the conflict going on yonder. I also added a poll of some sort. It should be on the screen. I think StreamYard measures it by you saying like a number or something. So 1, 2, or 3. And I think it's supposed to, calculate, I guess, on that. I don't know if it's precise or not. It's not as good as a YouTube poll, probably. Maybe the last time I do it here, because maybe it's better to just have it on YouTube where you just click it. Anyways, so I think it's what will actually scratch that. I think that's because it helps with all the platforms, or aggregates them all together. All right. Let's go into, let me have the timestamps because I need to keep myself relatively organized. I see you guys are typing in numbers and stuff. Okay, so first things first, yes, the Iran update. All right, there's a lot of controversy around this. I think people are very emotional, whether or not they stand on one side or the other. I think I'll be blunt that all the people that, said Iran had all the cards and like, well, those people, in my opinion, are wrong, have been wrong. And we've said that on the show, we said that in CM. I think it failed on any basic analysis. And, I think more and more people are going to see that as the time goes on, right? We are only just over a month in, and the market itself had repriced in a lot of risk. And so people always resist when we do see these intermediate rallies. They always say, well, is it sustainable? Is it just like the relief rally before something worse comes? And I don't recall a single, bottoming that we've seen that has never faced any resistance. We also had some nice contraindicators. We had that clown from TikTok say that he de-risked his client's capital. I posted it on X. He posted that on the 27th of March. And that was, I think, the exact bottom, if not close to the bottom. I'm pretty sure it was the exact bottom of the market so far. And so I think for many of you, I know from the celebrations, you're hitting like all-time highs today, as if nothing ever happened. And of course, that's very nice. And there's not just him. Like last year, right? We all celebrated or loved the idea and the moment Tom Lee cried on TV. And he apologized to his investors of his inability to see it coming, and that was the bottom, right? So we'll see if the same contras or similar contras here were indicative of the bottom. It's always when the clowns start crying that something like this poetically happens. So on the exact updates with Iran, of course, we have the blockade, which the United States is undergoing at this moment. And it sort of changed the tables a little bit, because while previously, and this is something I don't know why it's a surprise, the United States isn't as dependent on the Strait of Hormuz as many other nations are. Sure, some of the U.S. allies are, but the U.S. actually stands to benefit in a variety of ways. The U.S. is also securing alliances with other Asian nations that are also securing vital key choke points that are energy, not substrates, but energy pathways to China. So China is the biggest loser here. We've been writing about this thesis for over a year now. So all the Capital Mindset members, you guys know, in the macro and tariff updates room, we've been keeping track of this for more than a year, because this was when the tariffs and discussions were first being had. So that was quite literally at the very start of 2025 and culminated into the April panic, and then onward we went. The idea that it's typically all actions over the past, not just this administration, and even prior administrations geopolitically, have been geared towards countering China or removing the prime risk that I think a lot of investors do not appreciate, I think is more obvious than ever. It's becoming harder and harder to deny that. Last year, I entertained a lot of folks that had, let's say, dissenting opinions on this. But I think as time progressed, they became more and more evident. What I'm happy to say is that a lot of more prominent figures are starting to recognize this. So recently, Steve Eisman, shout out to his podcast, he brought on a guest, and Steve Eisman had the epiphany. I don't recall, I don't want to say it's the first time he said this, because maybe I haven't seen other times where he has said this, but it's the first time I heard him say this. And he's starting to give off the idea, or share the idea, that perhaps the market, what it's pricing in now, is greater certainty in the future. And one of those certainties is, of course, the collapse of the right now most chaotic regime in the Middle East. And following that, the removal of the prime risk, which is an adversarial confrontation with China. And so, because that probably is the one gray rhino that we could all find and point out. And in the case of, or sorry, I'll say black swan. It's fine to say black swan. It's the one black swan event that we could point to and say, well, that is probably something that a lot of people don't expect to occur. But if it did occur, it would be extremely bearish for markets. And so that risk has reduced dramatically. I see some people on X will say otherwise, and I don't agree with their points. I don't think they're paying attention enough to exactly the play here. And they, have, from their point of view, and I tend to see it as a bit misguided, but they tend to view all this ordeal as weakening the United States, when I think the evidence suggests otherwise. And the West in general, I think, has strengthened tremendously. So all of this is very bullish. It's bullish for stability. It's bullish for, markets. Inherently by bullish for stability, it's bullish for markets, but bullish for maintenance of supply chains. And a lot of supply chains have also, underneath it all, been changing. So recently, SemiAnalysis reported that we now, I think the number is 20% of smartphones still remain coming from China, where the goal, and I posted the story or the press release over a year ago now, the stated goal from Foxconn and Apple was to get to 25% by 2027. And a lot of people at the time doubted the ability to get there. Well, they got there pretty much ahead of schedule. And so it's only going to get better from here. And Foxconn was already laying the groundwork in Vietnam, in India, et cetera. And we discussed this as well for all the CM members who remember this point in the pitch or in the thesis, that Vietnam was going to be one of the main beneficiaries. And they looked at this whole ordeal as a way to gain or carry more favor with the United States and boost themselves economically. They're not really a best friend to the CCP, despite people sort of simplifying the region into saying, well, not Taiwan, I apologize, for Vietnam, they have the legacy of communism there, et cetera. They haven't been communist for quite some time, much like what China has done is a bit different from what China has done. It's not exactly a carbon copy. But they've liberalized in a lot of ways. And it's not the same sort of liberalization, obviously, that you experience in the West, but it's not the same Vietnam as it was 50 plus years ago. So all to be said, there's a lot of things, a lot of moving parts. We're seeing a lot of strong economic data in the United States. This continues to be a tailwind for trucking companies and the like. And we're seeing that, of course, in our investments in trucking companies and transportation space. So you're seeing that pick up those tailwinds. So you're getting rates plus volumes, or another factor of volumes. So it's exciting times nonetheless. Okay, so let's see if there's any questions. Let me turn to you guys and see if there's, oh my gosh, what you guys are trying to cause brain rot? I saw 6-7 there. Is this referring to Dave? Aha, British Warren Buffett. Doing thirst trap videos now. No, it's because right after this, I'm running to the gym. I'm running to the gym right after. Strongman does shirtless video. This is nothing. Come on, guys. Oh, someone trying to be cheeky comment with me. All right. How people not learn from the last years able to deal with this event? They should just quit. Yeah, well, some people are not meant for it. I only listen to Chris Sane. Yeah, Asian Kramer cried. Absolutely. On screen, put numbers in chat to take part in the poll. Yes, that's the way you do it. Version. Amazon. Yeah, we'll talk about Amazon. I'll start. We'll watch that. This is actually a nice little watch. I bought it in Switzerland. It's one of Omega's special edition. It's a swatch, so it's not that expensive, but they only sell it when it snows in Switzerland. So it's not even, it's an automatic movement. It's a quartz watch, but I like it a lot. Okay, a little 30% run on day. A lot of people are excited. Okay, 1, 2, 3, 1, 2, 3. Donald Trump stock market ripping. Thanks, President Trump. I don't assign credit to him necessarily, but it's the panic, the pessimism sets us up for things like this. And I've broken down, I don't know if I've broken down here publicly, but in CM for sure. So it's not a secret. If you look at the actual backdrop of biases, political biases among stock investors, and particularly fund managers who manage capital, they tend to actually lean more left, believe it or not. It's roughly 70% of fund managers in stocks, not in bonds. In stocks tend to be Democrat. And so for international viewers, that's a little bit more left, or tends to be more left. And then the remainder 30% is Republican. So it's not like an exact science, but you tend to see this like heavy pessimism, especially if the person is very infuriating to some people. And so in this case, that's why we see this like almost hysteria and people where, a lot of I think wise investors say you should put your politics to the side, etc. A lot of people can't do that. But in the bond market, it's reversed entirely. It's 70% usually lean Republican and the remainder 30% Democrat. So it's kind of an interesting phenomenon. No, referring to clown, you too. Oh yeah, yeah. Yeah, that was good. Yeah. I don't know if I should play it, but the guy on that I posted on X, he literally de-risked his clients. He made up a bunch of like random reasons why he did it, and no, it was funny. All right, let me move you guys here. I don't know why you guys have you on this other screen. It's better that you guys are here. Okay. How do my knees feel? So now I know who you are. Yes, it's a moon swatch. Yeah. So when I was over there visiting my friend, we went to the museum, etc. And there was the watch that they only sell when it snows. So I was like, why not? I'll buy it. Nice little memorabilia for the trip. Thoughts on? So we talked about him in the last live streams, but briefly, I don't think it's a big deal. You guys close out your shorts? No, because we maintain broadly a long short portfolio, but I can't talk about it too much. If you want, ask me in CM. I can divulge more. Can you talk about Netflix earnings post? Yeah, we can talk about that. Let me start it. Grew up there as a snug, was a Financial Times because Dubai, people trying to move there now. Yep. Good luck, I say. Poverty stream. All right. Yeah, 30% run on Dave. I think the fighting between the U.S. Iran may be done, but I'm worried about Israel taking part of Lebanon. That seems like a long-term issue. Well, long-term issue for the region. I don't really see it as too much of an issue for for the U.S. Fun fact about Israel: a lot of people, Americans, don't seem to know this. So in Israel, I believe it's like 45% of the population actually, ironically, thinks that the United States controls their foreign policy decisions more than their own government, which is really funny because you talk to some folks here, it's like the reverse. But a lot of people don't know that it's like conversely. But again, that's part of the information war. And so, of course, everyone has their own opinions on that. All right. So let's see where we are on time. We're pretty early still. I might have to change it because there doesn't seem to be any questions. Everyone seems to be on point. There's no rebuttals to the Iran issue, I see. Okay. Because I think the audience then is, let's say, aligned on this. And let me see. 80% of you gooned. Only 5% of you panicked. 15% of you were too serious for the gooned option, and so you said no. So I count that together. So 95% of you did not panic. Okay, the 15, this is how I read it. The 15% of you guys are very serious people. You would never, ever say that you gooned, even if it's anonymous. So clearly you're a very serious person or people. But I applaud you for that too. So my portfolio is always skewed towards tech, and I've honestly been having a field day recently. There's anything in tech sector that exactly excites you right now? Yeah, we'll definitely talk about it. But long story short, it has been compute. So everything in compute, and we'll talk about why. But I'll start your comment because we'll get back to this. 3,000-year issue. All right, let me see real quick on the section. So I think we'll start early on the next section. Oops, went full screen. Didn't mean to do that. Okay, definitely starting this. This is a Q&A question. Where communities invest, serious investors, short-term overheating. Yeah, this rally looks like it's very excited. But to remind you, a lot of folks said the same thing last year in April. I hate that it happened again in April. I really do hate that because now it's like next year, people are going to be like a muscle memory. They're going to be like, oh, it's April. You got to sell. So, yeah. So to my understanding, that the U.S. blockade was meant to block Iranian ships, but non-Iranian ships are okay as long as they didn't violate the sanctions that are already in place. So it's all about the existing sanctions. War continues longer than Trump says. I don't think that's what's happening. I don't think the war matters as much as some people are making it out to be. Like I said, I spent some time just earlier talking about it. And the illustration we also talked about this last week, actually. So thank you for reminding me. We have to be careful to not misjudge what the market is able to price in a short period of time. The market is very forward-looking. The market is more forward-looking than some people give it credit for at times. And right now, just like echoing Steve Eisman, because I'm happy that he said it, because it's something we've been talking about for a while. This conflict, if you look at it on a broader view, is actually going to potentially create a lot more stability in the future. And the market might be seeing that. On top of the fact that you still have a lot of tailwinds in the US economy that are still kicking through. So the conflict itself, if it doesn't really slow that part down, then it's not as impactful as you might think, despite contrary opinion to what you see of the loud people. There's always the loud people that come out when shit hits the fan, when things get hairy. A lot of people love to come out then. And, it happens even in the CM community. There's people that don't really talk, and then they only talk when things look really scary. And then they go back into like the little cave. They come back again. I don't know why, but they love to come out only when there's like, a little bit of fear and pessimism. And it's fun to watch them and take note of them, but they're usually like the contras. You have to be careful not to tell a contra that they're a contra, though. It's very important. If you ever find a contra, you can never tell them. So, yeah, the general positioning, which we're about to talk about, I think contributed to this, where you had overcompensation. And I think what we're seeing now is this like mass short covering. So if I look at some of the stocks that are performing extraordinarily well, Quantum is performing extraordinarily well. But broadly, again, this is more in the next section, the short positioning from many money managers was fairly negative. A lot of people already went to cash, or they increased their shorts a lot. And right now we're seeing that sort of like knee jerk. We need to buy, we need to deploy, we need to cover our shorts and go extra long. And so that's causing the, I guess, the more rapid response. Okay, so I guess if it yes, no, generally, I think if it drops, it's more of a buying opportunity than anything, because the thing that kept me up at night is genuinely Taiwan. And that's really the only thing. I don't think the situation in Iran was that much of an issue. I always was of the opinion Iran didn't have the cards. I loved that people on X were publicly saying this. So just remember them next time when they opine on something that they're kind of clownish. So don't have Gelman's amnesia with that. And I bet you those same people were the same people last year doing the same thing. So a lot of people judge things way too quickly and also allow their emotions to get the better of them when making conclusions. No, you're not a contra, Kronar. If you were, I wouldn't tell you, but you can just trust me that you're not, but I wouldn't tell you if you were. Okay, so the shoemaker point, yeah. So that's an example. So there's a lot of short covering. That's the fun, because when I show you the charts here, or some of the charts that we were sharing this morning. Let me see. Go. We're going to be 5 minutes early. Boomx catching strays. No, it's, believe it or not, it's not him. Well, Boomx does get very negative at the when things are hairy. You do see his activity jump a lot, but he's not the individuals I'm thinking of. Again, I would not. I said him because I'm not putting anything at risk by mentioning him. Okay, let me go here. Go here. That's so weird. Open image. No, I don't want to download it. I guess I have to open it this way. Hold up, give me a second. Okay, cool. There we go. All right, I'll leave it here. All right. Oh, including toast. I'll give my thoughts on healthcare in the Q&A. All right, how do I end this poll? How the fuck do I end this poll? All right, I guess stop the poll. So, yes, 95% of you did not panic. Congratulations. We'll talk about this too on software stocks. If Iran keeps straight closed for another couple months, don't you think countries like Taiwan will run out of nat gas? They have to choose between fabs or their people. No, I think more than what people, I think people are underestimating how much alternative sources can get through. For example, at least Taiwan Semiconductor has already secured their net gas supply. I know that from the update, so you can kind of sleep well at night knowing that they're paying well above spot in order to do that, but it's fine. They can literally pass on all the costs to the customer. And right now, I think the United States is more or less showing, at least for the time being, that the strait isn't as much of a strategic importance per se to the United States as is much for the Iranians, the Chinese, etc. I think a lot of the U.S. allies will at least not remain unscathed. Of course, it's going to hurt, but especially for countries like Taiwan and Japan, Europe, even a little bit. But for the most part, I don't think it's as much of an issue as you might think. Okay, so let me share this though. But it's a good question. I mean, all right. So this is sort of the recent relative positioning. You can see the pattern basically, and you're like the highlight at the top, I think, illustrates the point of surprise. We weren't even that down, and the relative positioning was extremely negative. So echoing what we saw last year, and the market was barely down. So this pessimism is what you might call the setup, the offsides approach. So for the most part, when we see moments like this, and when we see the clown saying, "Oh, I'm going to de-risk my client's portfolio," literally at the bottom, they're going to call and say, "Hey, what the hell? Why'd you get me out of this market?" They're going to obviously turn on the news. They're going to see the market new high. And what they did for their clients is, oh, yeah, they de-risked it. They captured all the downside, and then they took off capital and they didn't participate in the full upside. So, yeah, that that's the trapped sellers, one way to call it. So those are the trapped sellers. They have to buy back in at some point, and that pressure is going to start mounting and mounting and mounting. So you guys are talking about Microsoft bottom being in. We'll talk about that in the software. So I'll star. This is a good question. I'll star that for later. So I view Bloomberg and a few podcasts, like Goldman Sachs puts out a decent podcast. But those are more like the passive listens. You listen it to in the background, something comes up, you look at it, something interesting, maybe interview. Those are what I call like passives. You just like have them in the background. You're kind of working on something, but most of the information to kind of gauge how things are going is, well, you have public sources, which now with the advent of AI, you can program your own solutions to gather all these sources, by the way. We've been working with that a lot on the background. So, whether it's through Claude, whether it's through Perplexity Computer and the like, you can program a lot of things to sort of gather these information assets all into one place and then make judgments from there. So lots of public sources from the government itself, all the releases that they do, they actually provide a lot of information. And then if you're talking about, for foreign policy, et cetera, again, tons of public, sort of boring, long duration transcripts, et cetera, that give you a lot of information. No one reads them. C-SPAN conferences or C-SPAN live streams that can last 6 to 12 hours. You can get access to the transcript, run it through some LLMs, and then get just a general idea or ask follow-up questions on what was discussed. So I don't rely on someone who went to schools to study journalism, because I tend to find that they, especially through, let's call it corporate media, they tend to be very lackluster, either lie by omission, or in some cases that I would argue is not entirely super common, but does happen, a lie by fabrication. But both are just as bad. If you lie by omission, to me, that's still a lie. Yeah, that's generally a good question. There's all of the stuff that, at least in CM, when we're talking about, how we're viewing the situation, the thesis around China, et cetera, all of it comes from primary sources. And we compiled it. And I think Fuhat said the other day, it's at this point a ridiculous length, but it's basically a list of either primary and secondary and some tertiary sources that we compiled. Okay, so let's see. Dave Holding 2030. We will see what's going on with Intel. I started short, and so far, no, dude, I wouldn't short Intel. I would definitely not short Intel. Money market funds are 8 trillion. We'll see those funds come to the market at some point. Usually those funds only average 2 to 3 trillion in cash. Yes, that is possible. If we do see rates decline, yes, that is the flame that could fuel the market. So if interest rates do decline, which it looks like we're about to have a Fed that will do it. Everyone forgot about that, by the way. So we're going to have a Fed that is going to focus on lowering interest rates, but also performing a little bit of quantitative tightening. So unloading the balance sheet, which is constrictive, and at the same time lowering interest rates. But the lowering of interest rates may in fact cause what you're thinking about there, which you lower the attractiveness of a cash of treasuries, and suddenly, besides liquid, they're still going to be very valuable as liquid instruments or counterparty instruments. So they're still going to have utility to them. But beyond the utility aspect, as an investment that some folks use it as, so a passive parking of cash, yeah. So I'll say this. Intel, because I want to, just attack your point here. Intel is becoming very important. So what's becoming important in the fab space is more and more, it's the bottleneck of packaging. Intel is very lucky. They're very lucky that this is happening. But CPUs are becoming a lot more important in inference workloads, and at the same time, their fab business, which TSM is going to do phenomenal, by the way, but there's so much demand. There's so much demand, and the complexity of advanced packaging is let's say an obstacle that's very difficult to surmount. There's going to be a lot of business for Intel. Intel could very easily reach in the near future, as long as there's not a massive destruction in demand. We're talking like maybe a 700 billion market cap plus. So definitely not a short. I do not view Intel as a short. You can say you don't want to go long, but I'd be very scared to short Intel. So how do I get rid of this poll? I don't know how to get rid of this poll. Oh, there we go. Hide. Okay, there we go. So yeah, I just wanted to say that. So $100, absolutely. do the math on what 700 billion market cap would look like. It's possible. It's not like a guarantee, but yeah, it's possible. That's why I'd be scared to short Intel. We are definitely would not short Intel in the fund. Rate declines only if it's long duration rates. All right. So anyways, wanted to talk about the general positioning, offsides again, how everyone's feeling about markets. Tends to be a little bit more bearish right now, but things can change very rapidly. We were fear or extreme fear for quite some time. So just on those, easy to access look indicators from CNN, that's completely free for everyone to watch. You can notice that we've been in the fear to extreme fear for quite some time. We're now back to neutral because we're seeing this rapid loading up, so to speak, of risk assets. So so this chart is from UBS. This chart is from UBS. You can find lots of free resources. So folks who get access to these, they'll post them on X if you don't pay for stuff like this. But yeah, you can find it on X most of the time, because people who get access to these things, they'll post it all the time. So that's why X is a good social media platform for finance if you follow the right people. If you follow the right people, they share the right things. And that's the free option. The paid option is, well, you go pay. But that's the free option. Okay, this is a great question. I'm going to start. By the way, this question I'm going to answer in the Q&A. All right, looks like I covered all the questions, but yeah, this one was a good question. Yes, on relative positioning, this could very much happen. I have something else to share that I found super interesting. Let me find it, because it was shared earlier. So super early today. I'll talk about memory as well. I want to have a section on memory, because that one was interesting to sort of discuss and break down. A lot of people doubted companies like SanDisk. We're no longer long SanDisk, to be clear, but we exited pretty recently, as in this week. But I'm not gonna find this. Damn it! I should have like started or something so I could share it. Well, TSM reports tonight. That's something to talk about, by the way. We'll talk more about that maybe next week. Yeah, unfortunately, I'm not gonna be able to find it. But I will say, on the prior topics, again, the Steve Eisman podcast, the recent one, was I think very insightful for all of you who are a bit confused still on the whole Iran situation and what markets have been pricing in. Yes, the firm has been catching a bid finally. Absolutely, a lot of fintechs have. So fintechs were unjustifiably destroyed following the comment from the president saying that. Yeah, I say TSM is tonight because it's tomorrow, like super early in the morning. Because yeah, it's on Thursday, but Thursday like at 5 a.m. or something. Or not 5 a.m., like 2 or 3 a.m. Anyways, coming back. So yeah, if you're confused with like what's going on with fintechs, they're catching a bid where nothing has changed. We actually just gave the LP update to our investors, and one of the things my partner said, funny enough, about the fintech rally is that, well, there's not really much of an update for us to give you because the fundamentals have been the same. All that's happening is the relative sentiment of fintech is just getting a bit more positive. Again, it's sort of reversing. It's in like the cycle. It's quite volatile. So since about October of last year, there's been, some observable weakness in fintech. Then you had the comment in January of, oh, we're going to cap interest rates. Well, that's arguably very beneficial, right, to a lot of these fintechs. It was, according to the market price action, not beneficial. Go figure. So, but the businesses, we saw Dave report 2 earnings so far where both of them were phenomenal. And we're about to have the next one here. And we know that they were doing buybacks all along the way. Disclosure, we're long Dave. I think that's obvious. And the business itself is printing tons of cash and able to return all of it to shareholders. The fundamentals never changed. They never changed. So all that to be said, the current price action is just what we reflect as saying the market is just more paying attention, is more the appetite for this risk has increased. And we look at what happened with firms like Fiserv, which got destroyed. This is what brought down most of the fintech space. This PayPal Fiserv dichotomy that just sort of deflated a lot of the excitement around all the names. And these are not small companies. These were heavy hitters. Both of them down at a large sum of money. And of course, the best of them, like what we would argue, Dave, Affirm, and then even Upstart, Pagaya, some might argue, Klarna as well. All of them taken down with it. And what we might see on a go forward basis, especially if we continue to see more of the same, we see banks continue to say the same thing. The economy is not, in recession. We're not expecting some sort of massive consumer crunch that some people are expecting. We're seeing more of the same. Then the fundamentals continue to improve. The multiples continue to contract. In some cases, they're doing buybacks. Dave is. For Affirm, Klarna, they are not, and they shouldn't. But from that standpoint, right, this price action, I think, is just returning us to more of a not even fair value yet, because Dave is still fairly undervalued, but it's getting closer to fair value. It's on its way to fair value. Okay, great question on turning point generator. I'll answer that. I have a direct answer for you, actually, on that. Okay, Dave, my debt slave. Lol. All right, we are going to move on to the next section a little early. I'm moving on to all the sections early. 4 owner bought 4 times today, or 4 times recently. All right, so I mean, with Shift 4, I've answered questions on like my opinions on it. To me, it's just complicated. It's not something like I care to opine too much on. But it looks cheap. It screens cheap. Adyen's also been absolutely wrecked now. Do you have concerns about the continued emphasis on the subprime unbanked lending arm for Melli? No. So with Melli, I think actually it's fine because they're operating in a market that there's not a lot of competition. They're actually getting comped really well for the risk. The net interest margin is compensating. It's very high. It's compensating them both for the lack of competition, so they're the only ones filling the demand, but also it's compensating them for the relative insecurity in the economy, inflation, etc. So all in all, it doesn't really concern me. I think that Melli in the fintech side is with the right interest rates that they're clearly charging, which is extremely high. For us, we look at it and we're like, whoa, that's insane. But you also have to understand completely different market, completely different currencies. You also have to think that their credit markets are underdeveloped. So I think for that, it's adequate. If for example, that's why credit cards are high interest rate. Fun fact. Credit cards are high interest rate for a multitude of reasons. Some of them also regulatory that force the credit cards to be high in order to make sure they compensate for the unknown risk. So an example, credit cards are not able to dynamically just change how much credit they offer to you. So because of that, the lack of dynamic credit giving, I'll say, it introduces a risk, right? What if you become less creditworthy suddenly? They can't suddenly change. So that's why credit cards have to, and they can't change that interest rate on you. They can only lower it if they wanted to. But beyond promotional moments, they cannot increase it on you. So they're always incentivized to just put it to the maximum they think possible that you would fall under as a risk. And so, in the end, when we look at a lot of these credit card companies, how much they make as a percent of profit, and we look at their loss rates, it's not a magical business. So anyways, are there any BDCs provided by some private credit companies with good value? Okay, so for the BDC space, if you're telling me you really want BDC exposure, I would focus on internally managed BDCs. Believe it or not, I think the private equity firms, they're great to own the stock, the common stock of the PE firm. I don't tend to view I think that's where all the better returns are going to be, and where you're going to align your incentives more with them. I don't view the BDC, the publicly traded BDCs of them, like ARCC, as better than ARE. ARES. So that's Ares. So if you're looking at BDCs, I'd focus on internally managed BDCs, and you have two that are pretty popular that are also pretty good, and that's Main Street. Main Street's the most popular, I think, but also it's good. And then the other one is Hercules. So Hercules and Main Street focus on different things, but at the very least, like what you're getting with them, if you're paying the right price, Main Street, I think, still trades at a premium to book. Hercules, I think, well, I haven't checked their price recently, but they were just at book. And so at book, you're not paying a premium. That's for one. You're getting, obviously, it is risky, because if you look at what they're lending to, it's a credit product. What they do for these startups, for these smaller firms, and they also have this equity component. So that equity component gives you additional upside, but there's risk involved. You're just trusting that their underwriting team is doing the right thing. In being internally managed, the incentives are aligned with you. Externally managed BDCs, I'm not going to sit here and say they're defrauding you or anything like that. Their incentives just aren't necessarily aligned with you. They might be much more focused on asset gathering, managing a greater pool of assets rather than increasing the particular NAV per share or the income per share. They're less focused on that. I wouldn't say that they're not focused on it, because if you look at all of them, they all say that they are focused on that. But the incentives, I think, are not as good as an internally managed one. And therefore, I'm not surprised to see something like a Main Street outperform them, because Ares naturally is focused on providing value it has a fiduciary responsibility to its investors in the BDC, but it is also very focused on providing value to Ares shareholders, common stock shareholders. I'm sure they do good by their clients. But I'm saying with the public trade BDCs as an investment, that tends to why I say or prefer, the internally managed ones. Yes, it is trading at a premium. I think, though, it's because it's garnered a great reputation. The management team there has been excellent as far as BDCs are concerned. A lot of people don't like BDCs, period, and that's fine. But when you're looking at BDCs, Main Street is the gold standard for internally managed BDCs. So they're good. Gold at 4,800. Yes, BDCs. But yes. Oh, and so for the part of the big position for me, there's always been this back of my mind concern about nasty credit cycle. Yeah. So just pay attention to the NIMs, net interest margin, and they should be generating a pretty hefty compensation for that risk. A lot of their credit is really short duration, so you don't have to worry about it too much from that standpoint. I think that's going to allow them to be very dynamic. So extension of credit, contraction of credit, and they're not with what you want to pay attention is that if they're not dealing with like car loans or something that's like 6-year loans, etc. But if they're doing like a paying for products are not that bad because when you're looking at your book, you can expand and contract your book pretty quickly. And as long as they're keeping it short duration on their book, should be fine because they should be able to see when the credit cycle is moving unfavorably, and then they just contract their. It's not that the stock price is going to be immune from a drawdown. That's not what I'm saying, but it shouldn't blow up on you. So, all right. So let's get to the next section. So the next section is compute still a winner. Yes, absolutely it is. Well, what I mean by compute is still a winner. So I think one of the bigger themes that's going to show up this year and has been showing up for quite some time is that this era of compute is not slowing down. This demand for artificial intelligence, these LLMs, just compute as a whole, is not slowing down. When we look at the main beneficiaries, we have a few. We have the companies that provide the architecture, the infrastructure, all of that. And there's a ton. And a lot of you who have probably been invested in some of them, and you've done very well. And the other part is the actual ownership of the compute. We don't yet have full access to every single direct, I should say, to all of the actual models. We have you do have Meta, you do have Alphabet, and then you have the indirect exposure to Anthropic through Alphabet, Amazon, Microsoft, and through OpenAI as well. So you do have those indirect exposure plays to that. But the actual infrastructure, the ownership of the infrastructure, not what supplies to the infrastructure, it's sort of been pretty weak, at least over the past year or so, relatively speaking. Amazon has underperformed quite a bit in the Mag 7. I think that's going to start to change. We have Amazon now at 250 or 248, whatever it is. I didn't check recently, but let me pull it up. Stonk. We'll do Stonk. All right. And we'll share this tab instead. So let me make sure you guys can see this and bring it up. So this is Amazon Stonk. We're going to use candles, right? Because, why not? And we're going to look at the 1 year. So on the 1 year, well, actually now it's up 36%, but well, you guys know, just trust me that just a few weeks ago, 2 weeks ago, it wasn't up as much. But yeah, now it's at 248. So I wasn't bad on the guess. But 248, 250, tomato. Yes, candles. Alexandre. So with Amazon owns that layer. They own the infrastructure. What we're seeing, and this is, again, we talked about this so many times. My debate, my discussion or disagreement with Michael Burry stems from his complete misrepresentation of accounting standards. When he's talking about, he's making these claims that don't really have a basis. We've already broken them down on why if you go through my live streams, by the way, my public live streams, I believe it's in the title. When I do go over this, I spent about an hour breaking down like why Dr. Michael Burry is wrong on his argument about the depreciation. And we already had evidence for this going back last year. So the clear cut and dry example why he's wrong is if you looked at the pricing rates for this older scale compute, it was rising. And so it was correct. And I'm going to tell you, like, a lot of these firms and the accountants that audit these firms, they're fairly familiar with when someone's trying to depreciate something incorrectly. And the companies themselves tend to be actually more conservative. So I'm talking Amazon, Alphabet, Meta, etc. They're not out to trick anyone there. And in fact, we're going to see probably some of the silicon last even longer than what they say. In the case of Alphabet, that appears to be the case with some of their TPUs. But anyways, coming back to what we're seeing, of course, with H100s, H100 rates have been going on up for a while, since November of last year. And I believe that's in December or November is when I mentioned why Michael Burry's wrong, or broke down why he's wrong. And so what we're seeing is that trend continue even further. And what that means is the margin expansion at the hyperscalers is going to be felt here soon, as in we're going to start to really see it over the next couple quarters. The main beneficiaries, AWS, Azure with Microsoft, Google with Google Cloud, all of them are going to be winners. And then also throw in Oracle. Oracle is going to be a winner. You probably are also going to see some expansion because of just the sheer amount of demand in some of the neo clouds. I know that you're seeing some of the neo clouds perform very amicably, and that's no coincidence. There's so much demand right now for the compute that a lot of these businesses are recording more and more revenue. The neo clouds will fill in the gap for a lot of these main clouds, and the main clouds like AWS, which has been reaccelerating, and sometimes the market cares and other times it doesn't care. It reacting the way it is now is sort of comedic, because it's not acting on any new information. It's just flows here. But when we see Amazon report, we're probably going to see more of the same, that AWS is continuing to grow at a very impressive rate. We're going to see ads grow at an impressive rate. And retail might be the question mark. Retail is always the question mark, but I don't care as much for direct retail as I do for advertising and cloud. And that's my suspicion, is that over the next year or so, Azure, AWS, and GCP are going to continue to see, they're going to see more than what people might expect, margin expansion. And as the actual infrastructure layer of cloud or of compute becomes much more important. Now, that kind of guess a segue into memory. So a lot of people did not believe in the memory rally. Now, for full disclosure, we are no longer long SanDisk, but we went long SanDisk not like immediately early on. Like, we didn't capture the entire uptrend, but our average basis in the fund was around the $400 mark after averaging up. And so we did fairly well on it. And a lot of people at that time, even when we were averaging up, were all saying the same old shenanigans of like, okay, well, this is clearly a bubble, et cetera. You may be right, but not in the now. So we have pretty sizable or measurable constraints in supply, for at least the next few years. Now, that might bring up an interesting question, because I think it's quite valid. It's like, okay, but why did you sell them? Well, we are acknowledging that we won't time that top. So we want to secure those profits for the LPs, but we also acknowledge that the rally in at least SanDisk could continue. We prefer SK Hynix, which is our main memory play. So SanDisk was a great sort of supplemental energy play, but we prefer SK Hynix. So that's the full incorporation of the position. And so SanDisk, while it actually still might continue to rally, we could definitely see it going past $1,000 per share. We know we were not also going to time that top perfectly. And relative to SanDisk and the positioning among the other memory players, I think that SanDisk, while commendable and respectable, SK Hynix holds a more defensible position, and it's sort of at the bleeding edge pinnacle layer of what memory is going to be used for, HBM memory, which when you're talking about agents, the agent workloads, that is going to really bring into importance the HBM memory and the like. And so everything that basically SK Hynix dominates in, and as you can see with the partnerships that they've secured and who chose them and why, the king of AI infra, NVIDIA, which some people still call a fraud, funnily enough, there's a reason why they were chosen. And Samsung's in there too, to, of course, diversify supply chains. And we're not, before anyone asks, we're not that much of a fan of Micron. So folks that we respect on this matter, who are much more familiar or specialized in memory, have basically all concluded the same thing. And when we've spoken to them, that Micron, it's getting a big bid because of the space, and there's so much demand to go around. And of course, it's got the American premium. But companies like SK Hynix, it's not a competition. So what we're also expecting later this year is for SK Hynix to list in the United States, and that could provide further liquidity So in anticipation of that, we expect the performance to be, somewhat still good. So there's going to be some volatility along the way, but for the meantime, this memory boom, there's discussions on China supply coming online, all baloney. Not that the supply coming online is blowing, but there's reasons for why it's not going to play as much of an impact as some people might expect. And I think some of the memory guys get annoyed when they see that, people talking about that on X or stuff, because they frankly get frustrated with people who are, just like armchairing this. But anyways, okay, so let's see. This is live, Stoic Yield. This is live. So for Google, wait and see how OpenAI integrates ads. Yes. Okay, that's something we've been talking about here for a while. But yes, Google, we view it as expensive. Meta's cheap. Microsoft got very cheap. Disclosure, we're long both. Amazon's still cheap. Alphabet's more on the expensive side. And yes, exactly that. We talked about that just last stream. But the Alphabet has had unimpeded competition for search-based ads for a long time. What are you going to do? Advertise on Bing? Although Bing is a respectable business, by the way, it's kind of funny that it still generates Microsoft like 10 billion or 14 billion in profits per year. Hilariously, Microsoft's such an OP business that just has this like random rinky-dink business over here to the side that's just like, oh, it just brings in 14 billion or some amount. I don't recall if it's exactly 14. It might not be 14, but it's something in the billions, and it's kind of funny to think of the sheer scale of something like Microsoft. But anyways, yeah, I would agree with this statement. Okay, so a lot of people concerned about what the hypercode free cash margin expand, or will they permanently be a bunch of cash generative? When do you think the free cash margin to catch up to gap margins? So the free cash flow margin will always catch up as long as the capex has a return. If you don't think it has any return, then it won't catch up. Or you'll have a reversal. So if you don't have the capex generate an adequate rate of return in the future, then what's going to happen is the gap income will crash, will crater, and the free cash flow will jump. So the free cash flow multiple will crater because the free cash flow will jump because the capex will slow down and go to what you call a normal level. And then you'll have this like quagmire period where the businesses are depreciating all of these assets to zilch because the investments were horrible. I'd imagine the share prices would react accordingly. So there'd be some discount in all of the stocks. Now, conversely, if there is a return, which I got to say that there isn't one in cloud is kind of crazy to me at this point. It's kind of like when I see, oh, what's the return on investment that Amazon's going to generate on cloud? They have never proven that they can do that. I'm like, oh, well, it's like they had this thing called AWS. It's been a thing for this many years. It's probably their best business in the entire segment, all their segments. So I don't know, maybe they proved it by now. But anyways, so if you think there's going to be a rate of return, there is eventually at some point in the unknown future, a time where the compute and the demand will start to what we think normalize. But if you're generating a return on investment, let's say in excess of 20% per year on said investment, you just keep doing it until it stops. You obviously shouldn't stop. Now, the difference between obviously this and .com is like .com you built because you're anticipating the demand. The Cisco's were like, okay, let's build and sell more because we're actually making money. And then the other firms, the ones who are building the infrastructure, they're saying we don't have the customers yet, but we think we will. So that's the difference between then and now. Now you have Amazon who's like, we have this much compute. Oh, it's fully booked. We need more because we have these customers saying, I want compute. They're calling and saying, I need this. And Amazon's like, I don't have any. And they said, okay, fix that. And then Amazon's like, okay, let me go build more. And then I build more. And then they immediately start building more. And it's kind of funny that people draw this comparison when I think it's a bit of a, let's call it false equivalence. It's blatantly a false equivalence. And there's actually some nuances to the railroad one, but I won't get into that because some funny historical tidbits how government got involved. But anyways, so I didn't finish answering your question though. So the moment that starts to normalize, you'll probably see the infra play start to crater. And if they are getting a return on investment, you're going to see that rapid rise in free cash flow generation, because the operating cash flow will continue to rise and rise and rise. And then the free cash flow, the CapEx will start to normalize. This is why when you're modeling, you want to be very careful, especially using free cash flow. You want to be very careful to not punish a company for growth CapEx. This has always been the problem with people looking at Amazon, going back to literally the start. And you always had to take into account how much of the free cash flow was growth CapEx. You can argue about whether you trusted management back then or not, and whether at which point in time did you start trusting management that they were getting a good return on investment, because they continuously proved it. And then you, I guess, as the onlooker, have to decide how many years does it have to go by before you say, you know what, they're getting a return on investment all of these years. Like, we're seeing it in the numbers. They put this much money in, they get this much money out. I'm going to finally trust them that's saying they're going to put this much money in and then they're going to get this much money out. And so, what you want is a business that has plenty of opportunities to spend on growth CapEx, and the maintenance CapEx is manageable. You don't want a business with massive maintenance CapEx and it's not having any opportunities to really deploy capital to grow. That's not good. So, why did this go away? I was like, where did my screen go? Anyways. Where is Dave's fair value and future potential? I mean, it's a very direct question, but well, I'll say it this way: there's still a low multiple business growing at strong double digits, buying back shares, with not much need for reinvestment to grow the business. So those are some of the more ideal businesses you can think of, where it doesn't need to put a new dollar in necessarily to grow, or it doesn't need to put all the money back in to grow more into the future. And so you end up with tons of free cash flow available that you can then just return to shareholders. So those tend to also carry a higher multiple than at this point. I think it was single digits. I think now on a forward basis, it might be in the low double digits. So yeah. GEV hit my $1,000 price target. Yeah. So we exited GEV. And we think that, that was our fair value. We thought $1,000 was good, and we exited before $1,000 because we thought most of the upside that we could value was already there. And we found other energy plays that were really good too, that are also not being viewed by the market, interestingly enough. But yeah, Google's a hold for now. Not adding or selling. Yeah, that's how I feel. And if you do get a nice sell-off from the OpenAI advertising, etc., I think that would present an interesting opportunity again. But yeah, it's definitely on the high side. Also today, we pay for lower multiples for the big firms. Yes. Also today, we pay far lower multiples. Yes, absolutely. The multiples have contracted. Again, Amazon, when you do those adjustments, if you've followed Amazon for a long time, the adjustments to growth CapEx, when you look at the real free cash flow, it's pretty cheap. Some people have opted for simplicity. They look at just operating cash flow. So that's one way some people like to do it. But when you do that, you are like putting all your trust into the management team on reinvestment effectively, because you're not punishing the figures at all. You're just removing all the CapEx. You're saying it's all worth it. It's all really good. And you're not bringing the CapEx in to analyze it. You're basically saying I'm trusting all of it. at all the value that's going to bring in the future. Because normally, obviously, we look at free cash flow because we're trying to bring that CapEx into the analysis. That's why we add it in. But some people like to simplify and just do only operating cash flow. I do like to play around with the adjustments to figure out what is growth CapEx, what is not, etc. But yeah. I think I actually, it's not that I haven't done it before. I do it sometimes for like a quick and dirty look. So yeah, I don't want to make it sound like I've never looked at just the operating cash flow and been like, oh yeah. But yeah, if you have the time, I would definitely go into that. Degen into Bloom Energy selling out now. Yeah. Yeah, Bloom Energy. Didn't degenerate any stock, not financial advice. Oh, okay. You're telling them. What do you think about stable coin play like Coinbase or Circle? Don't like Circle because it's tied to interest rates. Personally, Coinbase not bad because Coinbase is going to be much more of an asset carrier, asset gatherer, holding all these assets in its reservoir and then generating profits on top of that. So I actually don't hate Coinbase. Not invested, no position, not short, not long. But from the sidelines, I'm sort of like a cheerleader for it. I like it, like Robinhood. I like it. I think they're good companies. As far as like, I definitely would not be a short seller here. Okay, so do you ever look at EMAs when buying stuff like SanDisk? Swing trade seems like it was a swing trade. No. We looked at SanDisk purely on the fundamentals, believe it or not. So SanDisk was purely a fundamental play. So same with SK Hynix. Like we genuinely looked at it and said, people are really misjudging the profit that these businesses are going to be bringing in. Whatever you thought it was going to be, or whatever people thought on X it was going to be, or whoever, they were misjudging it. It was going to be higher. And the same thing with SK Hynix. We don't think they're priced properly. It feels like Nvidia back in 2023 when granted I was among that crowd that was doubtful, should have not doubted it. But definitely even like right now, I would say people are doing that with Nvidia again. They're still doing it with Nvidia. So there's those of us who only allowed it to happen in 2023, and those of us who stayed with the same mentality, and those of us who think they're frauds, which is like, well, one prominent person I know, but well, I guess Dr. Michael Burry is one of them, and a few others. But yeah. Okay, so so to summarize the segment, the victory here, I think, goes to who owns the compute layer itself. I think the margins are going to expand. I think you can be long Amazon, Microsoft, Alphabet. I think Oracle even. I think Oracle could get to new all-time highs. I think that's set up there. There's so much negativity there, and I think people are negative for the wrong reasons. And then neoclouds too. So if what you're hung up with neoclouds is revenue growth, which is how some people are thinking about it, I don't think those guys are going to have any problems getting that revenue growth. I think the revenue growth is going to come because people are underestimating the compute demand out there. So if you're talking about profits, and if the market cares about profits, that's a totally different story. But if investors for the neoclouds are caring about revenue, top line growth, it's going to be there. So it's just, I don't know where the market stands, but I can tell you this: the moment the market starts to ask the question, oh, how much profit is CoreWeave going to have? Probably not the same margins as AWS, I can tell you that, because they're excess compute. All they are is excess compute capacity. So as soon as the core compute capacity catches up to demand, they're not going to have too much of a hot time. Have you AMD with the run up to the mid 200s OpenAI partnership? Is that too much risk attached to Sam Altman executing? No, I just think like the king of AI, Nvidia, is trading at a lower multiple, has more barriers to entry to really compete with them. And honestly, AMD is just a beneficiary of just that sheer amount of compute demand that they're getting business. Where AMD benefits, I think, from is what I talked about with Intel, where you have this increase in importance for inference, the CPU side. So GPUs, great, all that. But for what we're going towards now, which I can tell you, it's like, it's definitely coming. Or it's not definitely coming. It's definitely here. It's happening as we speak. The agentic layer of compute, which is not going away, the CPU becomes a lot more important. In AMD with Intel, well, it's them. They're right there. And then the GPU side is going to benefit as well because there's so much demand. So that's why all of the and TSM, all roads lead to TSM. And in this case, Intel is going to benefit too. Samsung is also going to benefit too on a multitude of ways. The AMD, I think you could stay long, but it's more expensive than NVIDIA. And NVIDIA has a whole load of reasons why it's not going to lose the crown yet. So I'd be short sellers of NVIDIA here. So, but yeah, to answer your question, no, I think it's fine, but I just would prefer NVIDIA. I prefer NVIDIA or some of these other plays. Again, even Intel at like 60, 70. If you're managing the position correctly, I think it still has legs, unless they fail to execute, because that's one problem with Intel. It's like they recently they don't have a spotless past. Okay, so let's get into the next section, which is software. Let me go ahead and adjust the timestamps so we can get back on track to being accurate with our timestamps. Oops, deleted that. Okay, cool. Oh, we don't need the 0. Okay, we're right here at the 15-minute mark. All right. So 1 hour and 15, software relief. Will it last? So right now what's happening, right, if you don't live under a rock, is that software is getting a nice rally. So Microsoft, CRM, ServiceNow, because IGV, of the IGV, Microsoft is the largest. Oh, let me actually put IGV here. So IGV is up 4% today, I believe. Yeah, 4%. So Microsoft is the largest component of IGV. So it's suffered tremendously from multiple angles. So there's the negativity around OpenAI. So its attribution to OpenAI recently has been actually a negative sentiment factor. And on top of that, well, Claude is killing all software, right? And so Microsoft being the largest component of IGV, which is the software ETF, the flows out of this has also been harming Microsoft. Now, Microsoft isn't as down as much as other individual components of IGV. So we'll talk about some of them now, like some definite great businesses and honorary mentions. ServiceNow, which today is back to $94, but just the other day reached 79 bucks, maybe. I think it reached. Let me check, see if we can see the low point here. Yeah, I think it did hit 79, but I could be misremembering. So ServiceNow, I don't think they're going to get disrupted. I think if you have patience, this one's one you want to keep on your watch list or add to or buy and just hold. I think they're going to be a beneficiary. But there are real losers for sure. I'm more confident that than ever. There are real losers in the software space who definitely will die. I'll give some obvious examples that we already know. And I know that we're not short, but Chegg, which I don't know if Chegg is even still around or if it's a 0, but Chegg was definitely a loser. You also have potential losers in their growth rates. So, Duolingo, etc. Sorry that I know it's a cult stock or something, but so some of these names, it's not so much that AI is killing them specifically, but AI is enabling a lot of competing products to come online. And then you have, all this is coming from Claude, but you have Claude sparing no one. You have Claude even sniping out non-software names. You had insurance brokers, Brown & Brown, Arthur J. Gallagher, Ryan Specialty, Marsh McLennan, like all these guys getting absolutely smoked for no reason. Now, I understand, well, not for no reason. I understand the rationale, the what is the stated reason, but I disagree with it entirely. So when I look at the landscape, I see there's tons of quality out there that seemingly for sale. Is it the bottom? I do not want to call that. I frankly don't want to call that. I think that, and the reason why is because the valuations still aren't this like horrendously low multiple. You still have these companies like ServiceNow, phenomenal business, very sticky product. I think it's still going to be a winner, but it's still trading at like 20 times adjusted earnings per share. Gap is right there at 56, trailing 12 months. Ford is a little bit less than that. It is under a peg of 1, I believe, but nonetheless, it's not this level. Like I said in the last week's live stream, it's not at this level where you can't. You have to ignore everything. For full disclosure, I am long ServiceNow, but I'm fully expecting this to be a patient hold, and it's not at a price that I'd say I'd put 20% of my portfolio into this. It's not that cheap. I think it's great business at a fair price, which sometimes is enough, but it's not at a price point that I say, oh yeah, 20% of my portfolio into this. Another one, FICO. Disclosure, I'm long FICO. So FICO getting a lot of hate, getting a lot of heat as well, right? And I'll talk briefly about it, but there's a couple things that are impacting FICO, not just the fact that it's also considered a software stock, but FICO, right? We have all this noise around the regulations with Vantage Score being included now. A lot of people, a lot of folks who are commenting on this may not be as familiar with how entrenched FICO is. FICO is not in its position because it's the superior underwriting product. Believe it or not. In fact, that's what we talk about when we mention Affirm, when we mention Upstart, when we mention a lot of these other companies. They have superior underwriting capabilities to that of FICO. FICO is a third-party trusted name. It's similar to a Moody's or an S&P Global. It's a stamp of approval. It's a liability funnel, right? So you say, I deny this claim for these, or not claim, but a loan for this reason. Look over here. This is my rationale for why I'm denying you. It's not because you're this or that or whatever. It's because, look, your FICO score is low. And it's not that they're crap, by the way. I don't want to make everyone think that either. No, they're good, but they're not the best. And that's not why people use them. So it's entrenched itself as what I always say, the lingua franca of finance, of loans. So the way you communicate, the lingua franca comes from the most common language. It used to be French. That's why we say lingua franca. And so today in actual language, that's English, right? Obviously. And in finance and in loans, when you're judging loan quality, loan books, you use FICO. So if you look at, for example, SoFi, right? That's a popular retail stock. When they communicate to their investors, to everyone, really, hey, this is our average FICO score. What does that tell you? Well, when you look at it and say, oh, the average FICO score is, I don't know, it's like 700, right? Or 720. It's like, oh, okay. That communicates to me almost instantaneously. They're trying to say it's of high quality, right? And so that's just the investor look. Now, if you're someone who's on the other side trying to buy a book of loans, a bit more intricate and detailed that read, but nonetheless, they're using a FICO score, an aggregated FICO score, to communicate that to you, to communicate that to the market. And you see that in liquidity. So liquidity is one of the main factors of benefits of using something like a FICO versus alternatives. And that's why the alternatives won't really be used. There's not really a reason. It's cheaper services than Moody's and S&P exist, for those of you who may or may not know. So Moody's and S&P charge a premium for their rating services. Well, why is that? Right? It's not a race to the bottom. That's not how this works. Moody's, S&P, Fitch, they are the lingua franca, but of publicly traded debt, right? And to keep the same example. Now, that triopoly of sorts, which they control the vast majority of the market there, exists and is self-reinforcing. Funnily enough, it is almost impossible. If I don't want to say impossible because I don't want to add like a absolute qualifier, I would, F it. It's impossible. You and I, we can have as much money as we want, and we cannot break into that. Well, with FICO, it's a similar story. Vantage Score, while has the semblance of a threat, isn't as much of a threat as some folks are making it out to be. And I think some of the international folks who may not understand quite well how entrenched FICO is in the United States, because it's more of a US phenomenon. They do have an international presence, and more so on the security layer and the fraud layer, fraud detection. But the domestic side, or the credit rating side, is much more on the US. So not really as tangible for some of the foreign investors. You might see comment on this. And for those in the United States who work with things that utilize FICO, you know how entrenched it is everywhere. When you're talking about like, let's take Upstart, when they're focused on the liquidity of their asset-backed securities, they still run and rate their ABSs on FICO. It's really, when you're talking about not utilizing FICO, which by the way is such a low cost on a relative basis, that's always not worth it not having it rated by FICO. Just to give you that liquidity. But you have like companies like Synchrony Financial that don't use FICO. But if you look at what they do, they hold all the loans on their books. There's never a point where they look to sell. They're focused on accumulating the loans and holding them. And so Vantage Score is okay for them. And once more, as I said, these are funnels of risk. So when we look at what Synchrony is doing, if you think for a moment that Synchrony is only relying on the Vantage Score for the underwriting, you're fooling yourself. Synchrony has their own underwriting processes internally that make the real decision, right? And they use Vantage Score as a supplement, and it also gives them a third-party qualifier as to why or why not you were approved for the loan. So that you can't say, oh, Synchrony denied me the loan because I'm wearing a tank top and it's not professional. And then Synchrony's like, you're not going to buy that, whatever. They use the store brand cards. So like, you're not going to buy that mattress. We're not going to extend the loan to you. No, they're going to say, hey, we didn't extend the loan to you. Well, why? Besides their internal model saying don't lend to that guy. They say, oh, the Vantage Score wasn't very high. You have a 500. 550, whatever. And that removes the risk. Now I can't say, oh, Synchrony is discriminating against me for whatever reason. So that's a lot of what these third-party tools are used. But FICO serves that purpose and serves the purpose of, again, being that lingua franca, providing liquidity, etc. For Synchrony, it doesn't matter. They just need a whole, push of risk. And Vantage serves that purpose. So yeah, a lot of the creditors, they have their own internal underwriting standard. They do not rely solely on FICO. Bank of America, when you go to get anything from them, they're not going to only look at your FICO score. And it's not like they don't look at everything. That's silly. But if you didn't know that, the more you know. So FICO isn't, the stand all be all of underwriting. So when people get that, you understand that the moat where it really is, and it has been developed over decades at this point. It's something you can just like uproot because you say, fuck it, let's change it. All right, so we talk a lot about FICO, and understandably so, but is a specific reason you prefer it over EFX, or would you find it reasonable to pair the two, almost like a combined hedge for one? I don't find it as a hedge because I think both will do well. It's not one does well and the other one does bad. Equifax has a bunch of other business lines. What's happening now is like they're pitted against each other. If you ask me, if you put a gun to my head on this, I don't think Equifax wanted this war. I do think this war was pushed by politicians amongst them because they had a good thing going for them. I think they really did. What FICO is doing now is they offer the direct product. So when you go to the actual brokers of lending brokers, you can choose to go through the bureau, or you can now go directly through FICO, and you get fed the data bureau, and then you get charged by the bureau for the data, and you plug it in through FICO, and then FICO now has a performance fee. So it's the $5 plus the performance fee, and the performance fee comes to more, but it ends up being less because if you go through the data broker, if you go through Equifax and avoid FICO directly, and you directly, then you still have to pay per pool. And so that part is going to be $10 per pool. And that could add up, especially if you're pulling multiple times. Versus the other way, it's going to be cheaper on every pool, and you have a performance fee obligation. So you only pay that extra amount when it goes through, when you get approval. So that offering from FICO presents a risk for something like Equifax, a perceived risk. This is why they've also been weak. But Equifax has other businesses, and you can think of them as they are a massive amount of data just held at one firm. And that data can be monetized in a multitude of ways, the workforce data, et cetera. So I don't necessarily view them as antithetical to each other. I can view them as complements to each other. They are they're unfortunately been pitted against each other. Well, they're not. I wouldn't call them best friends because that's also a mischaracterization. They're more how do I say? They're more acquaintances that work together. They're coworkers. They're coworkers. They're coworkers where middle management has now pitted them against each other because middle management doesn't want to give them a raise. That's so yeah, I'll go with that example, that analogy, I should say. But yeah, I don't view it as a hedge versus one or the other. Both of them will do well. If, for example, we suddenly see a rise in transaction volume for housing, both are going to do well. I think FICO is going to do better. I think Rocket's going to do the best in terms of torque when that happens. But FICO is going to do really well because FICO is going to have that pricing power multiplied by the factor of volume growth. So you have volume growth and pricing power. Boom, recipe. Equifax, you have volume growth, some pricing power as well. Boom, there you go. So the Equifax story, we already talked about this before. So I'm, but up to everyone else, is more so about the efficiency gains, them exiting a lot of the growth investments they've done. They've moved a lot more stuff to the cloud, and now they're going to have a lot more free cash flow to return to you as shareholders. So that's what's exciting about there. What about Oracle issuing currently new shares? So issuing shares is not the end all be all bad thing. Your question should only be, what is the return on investment going to be? Is it going to be greater? Now, a company can choose two ways to raise capital. They can issue debt or they can issue shares. Shares is the more expensive way to raise capital. Absolutely. Not going to say no to that. That's absolutely true. If you can help it, debt is, as long as you're not levered to you should not be afraid of using it. In fact, like, for example, Dave took on debt at 1.7% interest rate to buy back stock. That's a fine use of capital. They were super under levered. Oracle had a little bit more leverage, but they see this investment opportunity in compute and they said, we need more money. So they exhausted those opportunities, right? Where it's safe, where it's healthy, and that's what you want. And then after that, well, equity is the more expensive but safer way to raise capital for those investments. So your question should just be, what is that return on investment going to be? I'm not sitting here and saying Oracle is a guaranteed amazing investment. I have a suspicion it will return to all-time highs. But granted, Oracle is the higher risk, higher reward opportunity here relative to a Microsoft, for example. I think Microsoft, the market's not really worried about their balance sheet, but the market is quite worried about Oracle's balance sheet and like what return they're going to get and the amount of leverage that they're putting on their book. So yeah, definitely like not ideal, but so if I go back, add FICO to the bag 7. Thoughts on Uber today's price? What is Uber's price? I always mentally I like DoorDash more. I don't know what to tell you because I like the delivery business for both of them more than the ride hailing business, because that's where you get the advertising benefit. There's so many ways to monetize. So I like DoorDash because it's simpler. DoorDash dominates the United States, and I have a soft spot for DoorDash's founder. Man, that guy. As far as like founders go, like there's certain founders like for Affirm, like that guy's amazing businessman. The DoorDash founder, great. You always have to give credit to Mark Zuckerberg. Guys, wow. Well, Bezos, come on, but he's obviously he's still a chairman, but he's not the CEO anymore. So there's not hating on Daria, by the way. Daria is a great CEO too, but DoorDash still has their founder at the helm, and frankly, the guy's great. If you ever read his story, it's actually really inspiring. How he thought about DoorDash, how he executed on DoorDash in the beginning, etc. And again, that part of the business for Uber is what I'm more excited about for Uber. And for DoorDash, it's the pure play. And DoorDash dominates the United States, which I think is going to be a healthier, a more robust market. And Grab, which is the Southeast Asian Uber, fintech, whatever, that one's also interesting. So, that one's gotten killed. And if you think, and granted, I will say it's not like free money here, because there's concern about what's going to happen to the economies of Southeast Asia, which Grab operates in. As a fintech, as a gig economy platform, it benefits directly from the discretionary spend of the populace. So if that gets hampered down here, well, Grab's going to have some problems. But if it's kind of a nothing burger in the end, and we end up having greater prosperity in the future, Grab's going to capture that. But there's some other shenanigans with Grab that might put people off, though. Okay, I think we hear you with Oracle. You are believing in Ellison and his ability to execute and shrink the debt. Yes, I think that's where investors should focus on. If I was there, I'd be a shareholder all over it. We are discussing it. I'll reveal that. We're discussing it, but we're not there yet where we're buying the shares. I'm just saying I would not be surprised if we wake up in a year or 2 years from now and Oracle by then had already reached all-time highs and surpassed it. So the question all investors should ask is like, hey, what return on investment are they going to get? Everyone has different opinions on that. You got to figure out where you stand. If it's good, if it's a good return on investment, then it's a buy. If it's not a buy. Simple. Everyone's focused on all these other things. All right. So what are your thoughts on Intuit with the threat of Claude? Will people be able to create competing companies to TurboTax, forcing them to lower the cost of it? Tax has always been hyper competitive. That's nothing new. So TurboTax taxes are, I think, 1/3 of total profits. So it's always been hyper competitive. I think if anything, artificial intelligence is going to benefit Intuit. So I think that they're going to have a lot of distribution capabilities for all these small businesses, and I think that's going to be one of the more winners in software. There's losers out there. I can point some out if you want, but I think Intuit's actually going to be one of the winners if I had to guess. Disclosure: I have a small position in Intuit, but yeah, it's same thing with ServiceNow. It's like it's not a company trading at a valuation. It's like, oh my gosh, I have to make it 20% of my portfolio. It's like, oh, it's a great company. It's trading at a fair price. And I'll have some shares. I'll buy some shares, right? So same thing with FICO. FICO's phenomenal business, trading at a very fair price, I think, for the growth potential. But it's not at a level. It's like, oh my gosh, 20% of my current new money coming in, I got to put it into FICO. No, it's not there yet. It might not even get there, by the way, and I'm perfectly fine with that. But there's and there could be more pain in software. I don't know, but it's you have to be patient. You have to be patient with the winners in this space, because the losers will make a lot of noise as they die. That's another thing. So there will be losers in software, and as they die, their death cries will be very loud and be very scary for the ones who still aren't going to die. But everyone's going to be like, oh, I have no idea if you're going to just one day croak or not. So I'm just not going to play. And that's how investors in the space have been feeling. It's like, okay, I'm just going to leave it alone and I'm not going to touch it for a while. And that's why you see very rapid drops. You're seeing, on technicals, a lot of these are oversold. So we could see bounces. Like this could be a bounce. This could have been the bottom. What will be a sign if it's the bottom or not? So I'll say it here on live stream for all of you listening. So if you begin to see this this news cycle continue of like Claude releasing products, and you don't really see a reaction to software, that could be indicative that the sellers are done. And that could be the bottom. And then the market could be maybe much more constructive, because I'm saying broad selling. Because again, like I said, I do think there are some losers, and those losers may in fact trend towards zero. But the indiscriminate selling might be done. And you might have the more rational minded investors or the more rational participants in the market start to parse through that. Because I got to say, if nothing material changes with FICO, if everything we're talking about today remains true, and you get FICO at, a 15 multiple, that's crazy, right? That's crazy. If nothing fundamentally changed. And at that point, you'll have me going crazy. You'll have me going crazy, which I think equates to like what, a 600 price, something like that. So, in fact, the puts aren't that bad though. around there. The puts give you a decent annualized rate of return. Be selling them at that price, but yeah. Okay, so I have looked at Snow. I have not looked at Snow. Do you share returns on YouTube or do you keep that to CM? So that became a bit, let's say, wonky because the fund and like how it can be perceived as like advertising if it's not 100% audited. I share it with CM members in a more casual sense to try to keep it like it's not like oh, this is the official report, etc. But I have to be like just cognizant of that. So I'll say almost in a, I hate to be gatekeepy, but now that I have the fund's performance, for example, it's only for LPs. Only LPs will know the fund. And if we are advertising in the future, it has to be through the third parties that present the performance. So thoughts on Ulta? Oh, Ulta sold off again? What's Ulta at? It's at 500. Oh, it did. Oh, wow. That scream of do not touch retail. Screaming at me again. I'll have to look at it. I don't know what's happening. I already answered this one. Could you explain your thoughts on Affirm potential? How do you think about fair value? So Affirm in the credit space, what it occupies is a really unique position. So all of these short-term lenders, these BNPL players, what they're doing is they have reinvigorated or redone the way in which we provide credit to people. It's much more dynamic and adaptable. So with Affirm, you extend someone credit and you are approving every transaction versus a line of credit. So when you take a credit card, you've been given credit by a bank, by a lending institution, and that there's like a credit limit, there's an interest rate implied, etc. But they're not underwriting every transaction. I can go crazy. They're going to give me like $30,000, $40,000, and I can go, swipe this, swipe that, all the way up to my $30,000, $40,000 limit. BNPL is a newer way of looking at it because the technology, when credit cards were first introduced, it wasn't tenable to do BNPL. But BNPL is a superior product for everyone involved. For the customer, well, maybe for the customer, not so much, except for the fact that the interest rates get better. Because if all that credit products are is if I can match properly the credit with the risk, everyone wins. Okay, what do I mean by that? So it's like an insurance. Imagine if it was very difficult to tell that I was a good driver. It was very difficult, but you can just trust me that I'm a good driver. I have nothing, but I'm a good driver. Progressive loves me. And then Progressive, let's say, cannot understand that. They can't see it in the figures. They can't see it in the stats, et cetera. They're almost blind to it. So, and I say almost blind. So they might overcharge me for my risk. Why is that a lose-lose? Well, it's a lose for them because they could lose me as a customer. Let's say someone else comes along and they can underwrite me a little bit better. They can see that I'm an extremely low-risk driver and they underwrite me accurately. And then I leave Progressive and I go to the competitor. So Progressive lost because they lost a low-risk customer and they might have kept higher-risk customers. And that's why all of this lending, finance in general is like a game of hot potato. You want to not hold any of the hot potatoes and you want your competitors to hold the hot potato. So in the case of this example with Progressive, let's say they couldn't underwrite me properly. And so the price was not correct. I lost because they were overcharging me. They lost because they have this this potential that they'll lose me. And then they're left with potentially worse drivers on their insurance. And the same thing goes for lending. So in lending, if I can properly underwrite the risk and I can find all the people that are like, let's call it zero risk. And let's say I exhaust all those people. I go and I lend to all those people the zero risk, and it leaves out all of and I can find them and underwrite them accurately and I'm making an example that's made up that there's zero risk because that doesn't exist, but let's pretend. Then let's say I took them all and my competitors don't have them. Okay, that would be bad for my competitors. But all this to be said is like credit cards are a bit more broad or less accurate in their ability to underwrite risk. And so the person who is utilizing the credit card and let's say is very wealthy and has really good credit, the interest rate applied to the line of credit may not actually properly underwrite the level of risk. And if before you say anything, 20% of super prime, according to the data, carry a balance. So that's 20% of super prime that is paying too much for interest. It's 20%. And we're talking about super prime. We're not even talking about prime. We're talking about super prime. And so you keep going down the segments of prime, subprime, et cetera. And you have, again, broadly speaking, this inability to very precisely and accurately underwrite the risk. And there's a lot of reasons of why that is the case, but the product itself is not defective, but it's old school. It's too old school. Today, we have the ability to underwrite every single transaction that you do. And that's all that BNPL is. If that it has a bad connotation to it, but in reality, I want you to just put in your mind, BNPL is just evolution of credit cards. Credit cards have existed for a long time. BNPL is the exact same thing, except instead of underwriting a person at one point in time, I'm underwriting each and every single transaction. And I'm doing so at scale. And that's all Affirm, Klarna, et cetera, have begun to do. Affirm is, if you look at their differentiation versus the others, they focus on higher ticket items. So that is difficult. That's not easy to do. So you can see like their max potential is in the tens of thousands of dollars. To do that accurately is very difficult. It's really easy to underwrite small loans. It's really easy to underwrite very short-term loans, pay in four. It's very difficult to underwrite longer duration loans with interest-bearing and high ticket prices. That takes skill. That shows you who's differentiated from who. Anyways, so Affirm and Klarna are number one and number two, clearly. And then everyone else isn't even close. So coming back to Affirm, and we're going to get to the valuation, like the future potential, but that's like the general framework. It's like, what is BNPL? BNPL is a credit card, but it's a credit card that I want to buy this TV. Oh, it checks me, it underwrites me for the TV. Boom. I want to buy this other thing. It checks me and underwrites me for this other product. And every single thing is going to be scrutinized, and Affirm is going to accept or deny each and every single thing I try to buy. Of course, I'm making it sound like it's so annoying and problematic. It really isn't. It's a fairly smooth process. And again, same thing with Klarna. And you see the adoption of BNPL much more in markets with very underdeveloped banking systems. The difference is the United States is what it's hard for Americans, especially to grasp BNPL, is because you live in a society with a very developed banking system, which is not the case everywhere in the world. And in many parts of the world, BNPL, which they never built the credit card networks that we were used to, or the banking system never really went full flung into that. They actually got into BNPL and advanced faster in that sense than the US. But so like they jumped a bit. And somewhat of a bold prediction for my partner and ourselves, we think that the push towards the popularity of BNPL is only just getting started. And in the farther future, we're going to see it much more commonplace, much more commonplace. In fact, one of the ultra bull cases, before we get into the valuation, I'm kind of spoiling this. One of the ultra bull cases for a firm is that they become this underwriting as a service because they're so good at underwriting that they're going to start doing it on behalf of these other industries. And so that's something that does excite me, but we'll put that as like this aside of a potential that may be. All right, where did I leave my? I don't know where I misplaced it. Anyways, I won't look for it now. All right, I was looking for an example here, but anyways, so the other aspect that you probably pertaining to your question is the actual valuation of a firm. So a firm's longer term potential, right? Longer term potential. We have it penciled out that it could feasibly reach around the $100 billion market cap within the end of the next 5 years or so. It's totally foreseeable. They're going to be compounding at a rate in excess of, I think, 25% per year. And the advancements for them to expand internationally are also there, where we think that that's going to be a pretty large and significant growth driver. Right now, we're only seeing them in the UK. Klarna, conversely, because you're not asking about Klarna, but I imagine someone's going to ask about Klarna. Oh, I'm seeing the comment. Oh, I got a super chat. We'll get to the super chat after this. But someone asked about Klarna. Getting to you because you did ask about it. They are already really entrenched in some of these international markets, and they're very popular. Especially if you're in Europe, you definitely know what Klarna is. And in some markets, they're so dominant. Klarna and Affirm, and actually Max said this in one of the earnings calls, the way he envisions Affirm is like Affirm in the BNPL space is like a similar to an American Express, sort of like this premium-esque side to it. And Klarna will be a Visa because Klarna has a separate mission from Affirm. Affirm wants to be hyper or much more selective within the credit space. And Klarna wants to be everywhere. So it's two different missions, really. And there's room for both of them to coexist. And we'll say this, our stance on this is Klarna is super cheap right now, super cheap. For what it's going to be. In fact, at $5 billion market cap, it's ridiculous. But I won't be surprised if it's in the future 20 billion plus market cap. So there's a future for it. And Affirm also, given where it's going, and again, the ultra bull case, right, being this underwriting as a service narrative, or not underwriting, sorry, underwriting as a service scenario. If that becomes true, then yeah, you're off to the races. But you can look at the demand for their products, the demand, not for their underwriting as in like the customer, but who's investing in it and what are they doing? If you actually look at what recently happened, Klarna got a new funding round from Elliott. Elliott gave them quite a bit of money and upsized it. And that's sort of like a signal you can use from the market. The market is telling you from these participants, these institutional investors, they are telling you that the vintages have a pretty good return. And so when you start to see that pullback, yeah, you might start to get worried. But if you don't see that pullback in those vintages, then you're not going to really, I think, see this like epic collapse that some people are expecting. So, yeah, I guess like the last bit. Well, let me refer a different question. How do you think about Berkshire? Oh, okay. So that question I'll put a star on. But yeah, on the question on Klarna. Yeah, I think that you could play Klarna. Disclosure, I'm long Klarna. Long Klarna and Affirm. But yeah, so I am biased when I say that. So I just want to be very clear. And Klarna, I think like if you told me in a few years from now it's well over $30 a share, I wouldn't be surprised. I genuinely wouldn't. It completely overshot to the downside. And the recent scare, I think there was one writer or guy who pitched it who apologized for pitching it. That was funny. He apologized for pitching it. It's a completely different risk makeup than something like a Pagaya. You didn't even ask about Pagaya, but Pagaya and Upstart, which are these other fintechs that focus more on personal loans, Klarna and Affirm are much more shorter duration loans. So their money printing potential is much higher because when we look at, not to nerd out on you more, but the velocity of money, it's similar to like a grocery store. So if you look at a grocery store stock, I don't know, like Kroger. So when you're judging Kroger's margins are going to be really low. And you might look at that and say, oh, conventional wisdom says that's a shit business. Not so fast. So the grocery store business is more about not just the net margins, but it's also about the inventory turnover. So Walmart has a really low margin. I'm going to use F it. We'll just use like Seeking Alpha to make this point because I'm going to be lazy to get all these together side by side. We'll throw Target, Kroger. I want to remove Dollar Tree. Fuck it. That's a retailer. We'll remove this one. Okay, cool. So let me share this. I'm just doing a quick peer group comparison. And I'm just going to go down. Go down to the margin section. So here we have So let me zoom in and make sure everyone can see it well. So we have gross margins, net margins. Seeking Alpha isn't always precise, but this should be good enough in terms of accuracy. So net income margin, we have 3%, 6%, 3%, 3.5%, and 0.69%. And then we'll use gross margins as well. But if you judge it solely on this, you'd be mistaken, because if you think about it, look at the gross margins. So Costco is actually the best company here, has actually the lowest gross margins. Now we look at net margins, and Costco jumps up a little bit in the scale, just matching Walmart, and Kroger is the lowest. So what do we know about the quality here? So far, nothing. Now, scroll down to, this is not perfect. You really want to look at inventory turnover, but asset turnover kind of gets the same idea. Like it's capturing somewhat of the same idea, because there's also a bunch of other assets, but asset turnover includes that inventory turnover in it. But yeah, right here. So Walmart has an asset turnover of 2.61, Dollar Tree 1.2, Costco, the best one, 3.65, and Target at 1.79, Kroger at 2.88. So now suddenly the ranking changes in my book. The ranking changes from Costco being the best, and then Walmart. Well, Costco's also has one other detail about, the memberships, etc. Walmart being the third best, and then we'll add the second qualifier in a second. And Kroger being, it jumps from last position in the net margins to suddenly being one of the best, right? The second best. Now, where I'll defer and say Walmart is better than Kroger is when we, as investors, become a little bit more nuanced and we start to say, well, Walmart actually has this massive growing membership business that's matching something like a Costco. And so that deserves a higher premium. That stability deserves more. And so Walmart's better. But we're trying to keep it a little bit simple and say, like, on a first glance, like, what would you look at here? And why net margins does not tell us the story, because you can see at least Kroger jumps up in the list of quality just from looking at that as an example. So really it's about turnover. So why do we talk about retailers? That's an aside. That's just like whatchamacallit, one example of another industry, and we'll come back to these companies. So in the lending space, especially with short duration lending, we have something very similar to inventory turnover, but your inventory isn't like a can, isn't like a banana or an apple or a TV. It's money. So the turnover rate matters a lot. You know who has the really low turnover rate? Dave. Not to plug Dave again as like an OP business, but Dave's inventory turnover being money, right? When you go to the Dave grocery store, you're getting dollars instead of bananas and vegetables and meat, etc., or chips, whatever you're into, Pop-Tarts or cereal. But you're getting money. And so with Klarna, with a firm, it's the same thing. It's like, what is their turnover rate? So with short duration loans, the turnover rate is going to be really high. So the velocity of money is going through their system at a pretty attractive rate. And that's when you get the crazy compound effects, because their interest rate isn't like crazy. The APY of Dave is the implied APY is very decent. But what's helping it a lot is that turnover rate, the amount of times a customer engages with it and turns over the loan. They pay back the loan, they get a new loan, they pay back the loan, they get a new loan. And how many times do they move that same dollar, right? So how do we get that insane upside? Once you start to play with the numbers, like there's some of our members who once they ran through it and their eyes started to light up because they saw like how much these things could compound or can compound and are compounding. You see like the potential returns are pretty astounding, especially if you think the industry grows, and then if you think they grow within that industry. All right, so I'm back, and thank you for the super chat. I always appreciate super chats, especially as I'm like semi-retired. Well, thank you. So sorry to derail. No worries. You don't even have to. You don't have to say sorry, man. It's a super chat. Could you briefly explain what you did before you went full time managing your fund, and how the process starting one works is? Then you spend much time on it. Okay, so I'll be somewhat brief and to the point. So I had a background in finance and accounting. Studied both finance and accounting. Worked at a few firms. Worked in Big Four. Then worked a little bit stud in private equity, and then worked at another small, tiny firm. Come back home, and from there all the time through, I had capital mindset. And that built the track record among many of our current LPs. And you want to establish this sort of rapport. It's similar to another investor who is sort of like a similar inspiration, honestly, Gator Capital, who had a really similar kind of trajectory in that sense, like where you start this newsletter of sorts, or you start this investing club of sorts, and you're constantly updating your investments, how you think about different investments. And that's how you slowly gather this rapport with various LPs. So that's really the most contributing factor of them all, is providing that sort of like tangible and written down track record, and talking to folks all throughout that time period. You're building relationships, because that's really a lot of what it is when you're finding who these LPs are going to end up being. And even when you're now looking at new LPs, it really is about relationships. So, from the folks that came from CM, which is a good chunk, it's about 50% of our LPs, and those who came out of CM that know me on other levels, either through professional background or some of my other partners, right? So some of our LPs know them from their professional backgrounds. Because again, if you don't know, it's a team. It's not just me. I am the face of CM, public facing, etc. But I'm not the only partner in the fund. But from them, they have their own backgrounds. I won't get into theirs, and they've cultivated relationships over time. They have their own track records that they've established, and you get to the point where, when you're ready, which it's an expensive process, it can be a headache if you do it the wrong way. Definitely, it can be a headache. But if you have the right professionals backing you up, from legal perspective, from administrative perspective, and you get it down to that final moment, and you have that sort of rapport built with people who are willing to give you their hard-earned capital, then you're good to go. So the process of starting, to answer your question, to the second part of your question, is, well, exactly all that, right? You get through that, and you should speak to a good lawyer. The fees can be intimidating, granted. So and this is why I invoked Gator Capital. I think you also need to get to a point where you're financially stable. So hopefully through your own investing, you've generated some return that puts you in that position to be financially stable. Because that's why maybe a lot of the more traditional routes is that they'll start it maybe a little bit older. We're at different age groups or age brackets, myself and the partners. We're not too far apart, but it's not like not a single one of us is like 20 years old, but I'm the only one under 30 still. And the sort of stability I think it requires to take that leap, I think, is also important. So I don't think that actually is something that needs to be under stressed. So I think that answers the question. If you have a follow-up, you can ask, and I'll be happy to answer, because I don't know where I need to spend more time on. But if that's to your satisfaction, then yeah. So that's the process. I'd say there's get a good lawyer to set everything up and have everything sort of functioning properly, because you really don't want to fuck that up. That's very important. So yeah, but I'm happy to answer like any follow-up you have on there. Okay, so, and once again, thank you for the super chat. You mentioned in the past a channel for retired folks to help them manage their finances. Did you give up on the idea? So I'm still finding the time. I already just got this down, right? I'm doing a weekly Wednesday live stream. Let me work on getting the time for this, because so what you don't know, this is the public side, right? I come here, do one a week. You notice I don't do videos anymore, and although I should find time to do them, but I do a lot of content privately for the Capital Mindset Club. I'm almost accessible 24/7, not literally 24/7 because I do sleep, but I'm very accessible there. I spend a lot of time talking to the club members. And you can just ask them how available I make myself to them. And so that takes up a lot of my time. And it's frankly enjoyable because it's a collaborative research. And also the fund and meeting with the other partners takes up time as well. Also some administrative things that might come about. And so that's been put a little bit to the side, unfortunately, but it's not something I don't want to not do. I do want to do it. Let me, I've already stabilized this time slot. So maybe I have to find another time slot to sort of hone in and dedicate it to that. I don't know if I'll make a new channel. It may just still be on this channel, and I'm just going to have different titles and stuff. But yeah. So, okay. Awesome breakdown. No worries. Yeah. If you have any follow-ups, feel free to ask. Happy to get into it even more. Sorry to divert away from stocks. How do you view real estate over the next 10 years? A lot of noise about now working out as well. If you're, not working out as well. If you are fully invested in a real estate portfolio. So real estate's really cool in the sense that, so some of our LPs are real estate folks. Some of our LPs, we're their only exposure to stocks, in fact. So a lot of our LPs, they have their own stock portfolios, and we're like a diversifier for them. But other LPs that we have, they're like real estate guys, right? And I say, oh, stocks, and they're like, line go up, right? So I'm always talking to them, especially when markets get a little volatile. They want a little bit more reassurance, or like say, hey, you know what's going on? The market's down, or are we good? Like, but the part on real estate, like how I feel about it is, okay, real estate has a lot of advantages, particularly in the debt side. And I don't think it ever returns on a pound for pound basis as much as companies, right? If you look at because real estate to some extent is a commodity. I think you would agree. It's like, while the land is super important, that part's not the commodity, but like the buildings next to it, or the properties next to it, are somewhat commoditized, right? Especially if there's a lot of supply in a particular area, it can feel that way. And so if you look at the implied rate of return, just looking at appreciation and rent unlevered, it's never going to beat stocks, because stocks also embedded in the company. There's operating leverage, et cetera. So there's leverage embedded there. So, but where does it outperform? Well, the fact that you can borrow at 30 years in the United States, because for Canadians, you guys don't have fixed rates, but in the United States, you can borrow at 30 years fixed, which is crazy. If that was a product that was just starting out, for example, back in the day, that was an incredible product because it wasn't really priced into the markets yet, that you could lever up for 30 years plus. In some countries, actually, you can do 30 years plus, but in the United States, you can do 30 years at a fairly low interest rate. Sometimes, depending on where you are in the cycle for interest rates, like if you got lucky in 2021, a sub-inflation interest rate. So the fact that you're able to control that amount of capital. Anyways, and then you also have the flexibility of always being able to refinance. You can't do that with stocks. Like you can if you have tons of money with certain institutions. So for example, I know that some figures, if you have like 100 million plus with a Merrill or B of A, and I'm sure this is the case everywhere, you do have access to tools to borrow against your net worth. Robinhood gives some of these solutions for like the rich, but not super rich people, right? And that's who they're trying to attract, by the way. Robinhood's really tackling that believe it or not, they're underserved. Because Merrill or Bank of America doesn't really give you those really cool benefits until you're over 10 million with them. And then if you go over 100 million with Merrill and Bank of America, it gets crazy, like what they'll offer you. But anyways, so like with real estate, generally speaking, it's like, okay, you can borrow against this asset. That's the collateral for the loan. And there's a lot of tax benefits with it. So I'm establishing that framework before we get into your question. So how I view it over the next 10 years in the United States, there's some noise right now about it because of immigration. And so immigration in some markets, I'll tell you in my market, has had a real material impact on the rentals. And I'd say like a longer term look, I'd be bullish. I think it just depends really on where you're at, man. But because I'm sure you're saying yes, of course, but it really depends on where you're at. So real estate across the entire country of the United States, at least, am I like particularly bullish? Not really compared to stocks. But if you're talking about, if you know an area really well and you think it's going to develop, then I'd say that's like the nuance or detail I'm missing. So I'll say in my area, Florida in general, I think I'm generally bullish real estate. How bullish I am? Oh, I'm not gonna just sell all my stocks and go buy real estate. I'm not that bullish. I think my equities are going to outperform my real estate. But the real estate offers us a neat diversifier, a utility that's very important, because utilities, unvalued or undervalued, because you need to use the real estate. You're going to live somewhere. And at the end of the day, there are things I can do with the real estate where I can access that capital in a tax-free manner and pay for access to that capital via interest that is then deductible against my taxes, and then utilize that in stocks or something, or buy another real estate property, etc. So there's those benefits. But if you're fully invested in real estate, because now getting to your question, because I spent a lot of time rambling on the groundwork for the question, then I'd say, I saw the other comment, how you make money if you're, but if you're fully invested in real estate, then I don't know your situation, because now we're getting into maybe financial advice, which I want to be a little bit weary about getting into. But I'll say if you were me, or if I was in that situation, and frame it like that. If I was fully invested in real estate, I didn't have any stocks, and let's say it's all paid off real estate, there's probably some properties in my portfolio I might be giving me a headache. I don't know. If there's that, maybe I get rid of that, throw it in stocks. Or if they're fully paid off and I can stomach some adding some leverage to the real estate portfolio, and I can get a good interest rate that's attractive, maybe I cash out refi one or two, not the full thing, but one or two at maybe like 50%. I don't know, because I don't know how much real estate you have either, or how, in this scenario, how much I have. So let's say I had, I don't know, like a few million in real estate, 10 million in real estate. I could take out, if I had 10 million in paid free real estate, I could take out 1 million, 10% leverage. That's not unhealthy. With real estate, you can go a little further than that. You can go, I think, 50% leverage, take out 5 million. And throw it into equities. It's a nice problem to have, because a lot of people would say, well, those are big figures, but yeah. So I don't know if that answers your questions, Sam. But how I view real estate, I'm bullish. I'm not more bullish than stocks. And I don't know about the rest of the question, if I answered it or not. Okay, so MasterCard, Visa, or Amex? Oh my gosh, not even a question right now. MasterCard and Visa over Amex. And I see I answered your question. No worries. I'm happy to happen. Right, but no, yeah, not even a question right now. So let's explain why. So there are risks. Visa and MasterCard, they have the risk of stable coins. We have no idea. Oh, stable coins, right? And American Express they are a network, but they are also the issuer of debt. So they carry that credit risk. American Express and Visa are not. So inherently, also pound for pound, if the growth is the same, I would rather own Visa and MasterCard over an American Express, because Visa and MasterCard do not carry any of the same risks. Disclosure, I'm long Visa and MasterCard because I thought they were buys recently. And I'm not long Amex, so that should tell you everything. But Amex is cyclical. You'll see it go through cycle all the time, going back as far as the original salad incident. Amex has these like scandals and sometimes these credit scares, all that affect it. I will say Amex has the greatest durability of a business of the three, just because it's much more than a network. It's much more than a bank. It's a brand. It's a club. It's a membership. You join it, you pay these fees, and you do it almost the status or the feeling of it. And as long as they maintain that, they're sort of like this elevated product. Does that mean you pay whatever multiple for it? No. But it does mean that over a longer period of time, the one that I think will be least susceptible to disruption is American Express. Visa, MasterCard, I put the disruption probability as really low. So just because I said that does not mean I believe Visa, MasterCard are going to get disrupted, but it just means that I think American Express is even more defensible because it's a brand. But what is that multiple worth to us? Well, at the end of the day, American Express could blow itself up because it takes on credit risk. Inherently, it should trade at a discount to something that Visa, MasterCard, they cannot blow themselves up. Visa, MasterCard cannot overlend because they don't lend. They collect a fee. They're a toll booth. So not a question if they're trading at the same multiple with relatively similar growth, Visa, MasterCard. If you're getting Visa, American Express at like 12 times earning, which happens all the time, and Visa, MasterCard like 30x, yeah, okay, and they're growing at relatively similar rates, yeah, you can make the case for American Express. But I think right now, if I remember correctly, they're at similar multiples and growing around the same rate. So to me, not a question. Okay, let me go through the start questions. See, I love it when I get to this point where, see, I make sure I go through all your questions. And then after those are done, we'll go through all these. Amazon. All right, I did talk about Amazon. Amazon's a great buy in the compute era. By the way, can we talk about Netflix earnings in a post Warner Brothers Discovery era? Yes. All right. So Netflix, my goodness, what can I say? Disclosure, we're long Netflix in the fund. We got a great a buying opportunity on it. And, you know, if you guys have been following the channel for a long time, you know that Netflix is one of our big buys in 2022. It's a gem. But I never thought I'd get another opportunity like that again. And I think that's what we got. So let me, where did I put the Perplexity Finance? Here it is. I'll share my screen in a second. Let me just get Netflix up. So gosh, it's so beautiful. Such an easy company to model, by the way. Anything subscription like this is just so easy. So no headaches. Anyways, so Netflix post Warner Bros. Discovery. A lot of people like the merger. I like the assets, no question about that. My issue with the merger was what you're going to pay for it. So I don't want Netflix to pay whatever for it. I want Netflix to be smart about capital allocation and pay the right price for the asset. And in my view, what Paramount was starting to push it up towards, so to get a little bit more questionable. I was cheering and hoping, and at one point we added Netflix pretty heavy in the fund. It's one of our top positions because the suspicion was, and we saw in the options flow activity, someone knew something, right? You can't stop it, but someone knew something. We didn't do options, but some big orders came in for short duration options on Netflix, and those printed, by the way, whoever did that, that's probably illegal, whoever that was, but they did it. And Netflix, that was sort of like one of the signals, an inkling, and I was hoping and begging that Netflix management was smart about it, wouldn't up the offer on top of that. And I think Netflix has phenomenal assets already. I think that Netflix's model is a winning model, and Paramount will have great assets with Warner Brothers, no doubt, but will be saddled with tons of debt. And I have a stinking suspicion that in the future, Netflix will be able to get something else at a good price. And I think it might come from something that happens there, because Paramount's going to put itself in a precarious situation with lots of debt. But anyways, coming back to Netflix, I think business as usual. You got a great business at what was a good price, and it's just going to continue to execute, return capital to shareholders, get those same economies of scale that we talked about all the way back in 2022 that a lot of people were missing. And they're already at a level where each incremental increase in subscriptions and price and revenue, I should say, to keep it simple, goes straight to the bottom line, because the costs aren't escalating at a much more drastic pace anymore. Okay, so portfolio is always skewed towards tech. Let's have a field day recently. Is there anything in tech sector that really excites you right now? Great question. So within the tech space, there's nothing that's, I would have said Amazon and hyperscalers not too long ago. I still think Microsoft's decent. Like the theme of hyperscalers is one big one for me this year. there were some ancillary plays in adjacent to data centers, like memory. If you asked me a little bit ago, it still does. Like SK Hynix excites me. But if you're really asking about software, I think FICO, if you do end up seeing a recovery in volumes, is going to have a lot of torque to it. Those earnings are going to grow a lot faster than what people are thinking. But like I was just spending time later saying, because I'm just getting to your question, I think that you have to be patient. If you're investing in any of these tech software firms, we could have bottomed. We actually could have bottomed. That could be it. But invest with the expectation that things could get a little more hairy, because none of them are trading at multiples like low double digits or single digits. Adobe is, I think, the only one that I can think of. But Adobe has structural growth questions behind it, and that's the reason why. But the ones that don't have structural growth questions, none of them are trading at like stupid cheap levels. The only ones that are the ones that the market is questioning its forward growth. That's why I'm saying, like, ServiceNow, the market's not questioning ServiceNow's growth right now. I don't think so, because if it did, it would trade a lot cheaper. Axon's interesting. We're long a stock. I'll name it here. I haven't talked about it really too much, but we're long a stock called Evolve, EVLV, and that was a recent buy we were able to pick up. So I think it's just above $6 now. So again, disclosure, we are long Evolve Technologies, but this is one I like a lot. So they do a lot of the screening security systems like metal detectors, etc. They have a recurring revenue side of the business and a non-recurring revenue side of the business. The recurring revenue side of the business is very predictably going up and to the right. We have a suspicion they're in the acquisition targets for Axon, which is a phenomenal business. It's just always a question about the price, but Axon's a phenomenal business. And then Evolve Technologies, this might not be a public company in the future. This is tech-esque, right? So it's not maybe traditional tech, but this is one we like. Salesforce is on our watch list. Viva is there. I wouldn't say I'm excited, because your question about what it really excites me. Honestly, what really excites me, you know what, I am pretty excited about the Constellation family. So Topicus, like VMS software in general, I'm fairly excited about that. FICO, VMS. But yeah, if you asked me a few weeks ago, I mean, I'm still kind of excited by hyperscalers at this price too. Like, Amazon's been consolidating for a minute. Don't kid yourself. And I think the margins are going to expand much more than people expect. All right, that answers that question. All right, let's go to this one. Considering the upside, but also the risk with the name like Turning Point Brands, how would you position like this? Oh yeah, so if you guys haven't seen, I did do a pitch on Chit Chat Stocks. They invited me on to pitch Turning Point Brands. That was back in January, and it's a lot lower than when I pitched it on Chit Chat Stocks. Full disclosure, we are long Turning Point Brands, and we're still buying it. Fun fact. So where is it positioned? I want to kind of build it to 5%. I'm currently at 2%. All right, I'm not going to give you financial advice, but the high level of how I'd look at Turning Point Brands is, and I mentioned this in Chit Chat Stocks, and the risk manifested itself somewhat. The risk is the FDA. They don't technically have approval. They're on the fast track process. And so because of that, it's tough to justify double-digit percent position. If you're already at 2%, here's the thing. Turning Point Brands is one of the stocks that I would say has the potential to 10x. Potential. It has some risk to it. So 2% would become, all else being equal, 20%. That's a great return. And I think that's a fair amount of risk, as in that's a responsible amount of risk. Because think of it this way. If they get denied, you could get cut in half. You'll lose 1% of your NAV in the portfolio. You'll survive. If you put 5%, you're going to lose 2.5. Just a thought experiment, a mental exercise. And if it 10x's, because that's frankly some of the potential here, if within the pouch space, if it 10x's, you'll be very happy. And in both cases, you'll probably have time to add if you get confirmation. So I think honestly, the 2 to 5, you're not at a level where I would caution you. If someone asked me, and conversely they said 10%, you could be super right and it could do really well, and I'd be happy for you. I just saying you should also be very comfortable with the possibility it gets cut in half because the approval doesn't go through. That you never know. You can't model that. You'd have to have insider information, or not insider information with the government. You can't model that. So you just have to think of that in your risk profile. It's like, do you want that possibility? Are you comfortable with getting a 5% cut in your portfolio value, all else being equal, assuming nothing else moves, because maybe you have other names that do well? Are you okay with 2.5%? Because that's how you can kind of think about it. If you put 5% in this thing, could you stomach 2.5% of your portfolio getting wiped out? Or do you want to wait? If your total target is 5%, or maybe your target now is 5% because you're thinking that way, and this is how I feel about it. We're at a single digit allocation. We will make it double digit allocation if we get that FDA approval. I don't care if it's up 10% that day. I'll buy more. But that big risk that I did mention in the Chit Chat Stocks pitch, that's the main risk. If that goes away, then I don't care paying 10% more for the stock of a company I think could have a 10x return. And that's already after a 5x return, by the way, or something like that. Actually from the bottom 5x return. So yeah, I'm okay with that. You don't have to go all in right now, 20% allocation because it's going to 10x. No, you can be responsible about this and think about your downside more than your upside. The upside's there's downside, and you want to respect that. And I think that's about just, risk management. So hopefully that answers your question. That's how I think about it, etc. Thoughts on healthcare? Okay, so healthcare, really, obviously difficult time. I'm a fan of United Health. I'm also a customer, just what happens, but I'm not a fan because of that reason. But I think they're a very stable, dependable business in the future. And I think if you can be patient with it, I think they'll do well. Microsoft bottom in. Ooh, I'm not going to call bottom on anything, man. I like to see other people call bottoms, but no, I mean, it could be. I think the value here is good, is all I'll say. What was the most obvious confident buy you had after Meta in 2022? Because a combination of huge remaining opportunity, cheap valuation, and a sure thing. Oh, TSM. TSM was the big one. Yeah. Like TSM has been a lazy long. So when you say confident buy, I tend to think comes to my mind lazy longs. One of our lazy longs we just let go of though was GEV. That's still probably a lazy long, by the way. Yeah, that's a lazy long. TSM's a lazy long. Yeah. So that's kind of how I'm thinking about that framing of the question. Amazon, I think, is a lazy long, more generally. But if you're talking about recent buys, like Dave, which and when I say I went long Dave, I went very long Dave. And that feels like it's tough to say sure thing, but I did allocate a lot to Dave. I have no idea if it's going to hold 230. Still cheap at 230 though. Someone who recently started focusing on long-term investing. I'm trying to think through, doesn't a market rally work against me by raising entry prices? How should I think about that trade-off? So yes, absolutely. The higher prices are, the lower your forward expected rate of return. However, waiting for the next drop. So let's pretend this is the bottom. Let's pretend for a moment we bottomed. And the next correction isn't for a while from now. Waiting for that correction could be detrimental enough. And generally, I think at any given point in time, there's always an opportunity somewhere. There's something that is a good buy. When things get really difficult because everything is overvalued, you'll notice because you really won't find anything that's a good buy. But if you're talking about indexes, the rule is always dollar cost average. Plenty of studies have already come out and showed that trying to time the market with dollar cost averaging and indexes tends to actually lead to underperformance. It's always just better to lump sum, not dollar cost average. That's what studies show. Lump sum is better than dollar cost average for that very reason. Because time in the market beats timing the market. That whole repeated phrase. There's reason for why people say that. So that's separate from individual stock investing. And individual stock investing, if you're willing to take on that specific company-specific risk, there's always something out there. There might not be something maybe that you understand. That's also true. All of us have limits, like where our universe gets, it's not very big, and everything in our universe is expensive. So that's a possibility. But as far as like the equity class goes, the equity asset class, I think it's at most times, and especially like if I'm correct in my thesis that we have just removed one of the larger black swan risks from the table, I think you're structurally bullish here, man. Like, I mean, again, that's the thing about a black swan. You don't see it coming. But I don't know if this private equity thing, I'm wrong on it, and it actually is a horrible thing that destroys us. That could happen. I could be wrong there, but I don't think that's going to happen. And I think that the biggest one that I can see is going away. And so I'm structurally bullish. So anyways, you don't have to worry maybe about a Great Depression of some kind. So what percent of the port is fair to, so similar question before, but I'm going to see if there's anything different. Okay, so it's the same answer as before. I'd say it's like put in what you think you could stomach losing half of right now. And then after you get the approval from the FDA and you get that 10% plus spike, then think about buying more. Because at that point, one of the biggest risks are gone. And so I truly believe Turning Point's a potential 10x. But you need to worry about that downside. You'll have time to add to it. If it goes from 80 to 120, and the thing's going to I'm just using a 10 example, 15 billion plus market cap as a more higher end maybe potential, then you're gonna cry that you didn't buy all of it at 80 and you bought some at 120. No, because when it gets to that other price, you're gonna be like, oh, it didn't matter in the end. But your risk management was better on point, because you're gonna cry your eyes out if you put 20% in it right now, and then they get denied by the FDA, and then you're sitting on a 50% loss. Then you'll cry. So think which way you fall. Some people are insane and will go 20% right now. And kudos to you. You either are extremely confident and know the process of what's going to happen with the FDA, which you might, or your risk tolerance is really high. That could also be the case. It's fine. Yeah. Okay, so a different question. How do you think Berkshire will do now that Buffett is? I don't have a good opinion on this. I probably, if I gun in my head to guess, I think it'll do like, because of its size. It's not because they're bad or anything, but I don't think it's gonna do that much more than market. I think there's a chance it could outperform the market, but I don't put it as a high probability. Not an impossibility. An improbability. All right, so this dude is glowing skin. The fuck? Noah, the short seller, is here. There was a lot of questions that came in. Woo. All right, let me go all the way up. I'm looking at cybersecurity portal. Do you have any on your watch list? Frankly, all of them, but all the it's a small one. Okay, so there's one that we own. If you can't buy it unless you're international markets. Full disclosure, we're long this one, so I'm biased in what I'm about to say, but it's the main competitor to CyberArk. If you guys know CyberArk, which recently got acquired by Palo Alto, and the company name is Wallix. So that's the one we're long currently. It's a European firm, French firm, by the way. And the thesis that I'll say briefly on it is we believe that European companies, which there have been new requirements put in place by both the French government and the EU, will push for greater utilization of this product. And their main competitor is an Israeli firm, CyberArk. And we do think that the prejudice against Israeli firms is going to go up in Europe. Or it's maybe ignore the comment on prejudice. Just say there's going to be favoritism to local businesses in Europe, in particularly France. And so that favoritism is going to translate into greater growth, which we are seeing, by the way. It's like it is happening. The price hasn't reflected it really yet, to be honest. So you missed some of the rally, but not a lot of the rally. It's kind of actually fascinating to watch. The business is executing. But yeah, Wallach's we think is going to do fairly well just from that focus of at-home bias or adoption from European firms, particularly French firms. And yeah, that's one. And then from US large cap cybersecurity, Fortinet's the best one for shareholder friendliness. Palo Alto's just, buying everything left and right and plugging it together, hoping it works. And it is generally working. CrowdStrike is amazing, but my goodness, are they super liberal with their compensation. And Sentinel One also fairly liberal with their compensation. Interesting products we hear. Cloudflare, probably really important in the future we're heading towards for the secure internet. One of the most indestructible sticky products, Zscaler, but also extremely liberal. They're all like extremely liberal with their compensation packages. So yeah. Do it more from everything. Looks like safe time to start a position. Yeah, I'd agree. So I think it's good here. Okay, if you had to put 100% of your personal portfolio into one stock, what would it be? From now, if I want to put in a little bit of risk, when I say a little bit of risk, I'm being liberal with that phrasing. I think a firm's going to compound at a healthy clip. My problem with it is, there are things I know could get clapped on. I could cheat to your question and say like a Kinsale, something like that, where I know it's going to compound at a respectable rate, and I don't think it's going to blow up. But do I think it could outperform in every environment of the market? No. But I think it'll compound respectably well. I'm assuming I can't choose an ETF because 100% into anything, I'll just do an index. But an individual stock, like maybe a Kinsale would be an option. I want to be wary about a blow up risk. So that's why a firm would be attractive, but technically speaking, there are some risks that I wouldn't stomach 100%, or nor a Dave. Oh, those are still really good plays. And that's why I couldn't put a turning point into that. Maybe an Amazon. I'm very confident in Amazon, similar to a Kinsale or Microsoft. Do I think I'm going to like destroy the market with Microsoft? Maybe not. Probably not. Do I think it's going to outperform from this price? Yeah. Over what time frame? You gotta be specific. Noah, the short seller, is here. He's saying it over and over and over again. Oh, he's short. He's short US. That's what he wants to tell us. All right. Favorite sectors currently. My favorite sectors currently: fintech, infra, energy, but energy in the energy infrastructure, not like oil. But and infrastructure in general. So fintech's already said. Insurance is looking like it's going to eventually hit that hard market, and that will be interesting. So that's on my watch list. I'm really trying to focus on that. My skin is glowing apparently. I don't think it is. I think I'm just white, man. My shilling PE. PE is also for that other question is interesting. So alternative managers. Palantir arguably has the greatest, let's call it visibility on cash flows. Anything government. That's what the same thing with Axon. Like Axon trades at a extreme multiple because it has insane visibility on future cash flows. So it's hard to like appreciate the premium the market sometimes gives to those kinds of cash flows. So not that I'd be buying it. That's the problem. Why would FDA approve a nicotine pouch? I don't understand that question. What do you mean makes no sense? Okay, let's see. Oh yeah, Noah wants to let everyone know he is short the United States. I'm very happy that you're short the United States, Noah. If I had a star, I'd give it to you. Yeah, it can recover if they get their shit together on utilizing the assets properly. How are you thinking about current exposure to tech, fintech? Do you view the portfolio as overweight these sectors broadly? How do you manage sector concentration risk? To be honest, I don't care as much on like factor exposure as much as some others might care. I focus strictly on the fundamentals first. We consider it, so, but it doesn't drive us at the end of the day. We focus on what we know the most, what we can predict the most, and what we can see as far as like that future value. But that's where the growth is. That's where the understandable growth is. And tech is very broad, right? Because like tech, do you also consider TSM technology? Do you consider the energy infrastructure companies technology? Do you consider I guess, well, software is always technology, but yeah, what do you consider technology? Do you consider hyperscalers technology? I'd assume yes. So tech is super broad, right? Within tech, there's a lot of things. Not all tech does well at the same time, right? NVIDIA is tech, or TSM is tech in that respect, or it supports tech. And so it's tech adjacent, but it's doing well. And you have software dying, right? One is killing the other in a narrative. So yeah. I used to do this. I want to do them again if I have time. Can you please talk about ARE? So for Alexandria, for all real estate, all REITs, the main driver is going to be macro-wise interest rates, where long-term interest rates are going to be. So you have to know that when you're getting involved with a REIT, given its structure and what it is, you're going to have, if you want to time this, you want to hold this, and you want to get the best price possible, you have to have an opinion on what long-term interest rates are going to be, because that's going to affect the valuation. Secondary to that, because, well, rates also affect their cost of capital, which also affects their growth. So that's another aspect. But so it's not just the valuation, but also the fundamental picture. Because if interest rates are too high, their cost of capital is higher. If their cost of capital is higher, they're going to grow slower. And the public markets and the private markets aren't always in sync. So the public markets might be reflecting and increasing the cost of capital, but the private markets, when you go to buy real estate, the prices haven't budged enough to reflect it. So that could present the problem. So really just focus on, if you're looking at Alexandria, focus on first, what's your opinion on long-term interest rates? Is it up or down? Second, okay, what kind of real estate do they own? Well, what happened was, in the office space, a lot of offices got converted to the more healthcare oriented space, and that increased the supply. Remember that real estate in some extent is a commodity. It's not that differentiated. The land might be differentiated. So like, okay, oh, I have this property in bumfuck middle of nowhere, and I have this property in like downtown San Francisco. Yes, the downtown San Francisco is not comparable to bumfuckville property. And so the one in San Francisco will carry a higher premium, better growth rate potentially in rents, all that thing. So to an extent, it's a commodity. So the property in San Francisco and the property next to it in San Francisco might be a lot more competitive. And if one is vacant and the other one isn't, and they're the same kind of property, that could put pressure on the one that's not vacant to not increase rents too much, because then they'll just move next door. So that's the other thing you got to focus on with Alexandria. Right now, Meta or Amazon. Meta's cheaper. Amazon, much clearer path for a lot of growth. Tough to say there, man. I'm gonna throw my hat with Amazon, knowing that Meta has more torque, though. Like Meta is gonna have more torque, and Mark Zuckerberg just surprised everyone. I'm a shareholder of both. I'm not selling either. But well, in a case, I did very recently buy more Meta, and I didn't really buy more Amazon. So I guess that's in a way an answer. Small cap investing for people under 40K. If you can actually read, would you recommend small cap investing for people? You can do, no, that's a fallacy. That is a fallacy. You can do just as well investing in large mid caps. The size of the business should not be the primary concern. That is a supplemental factor. So what does that mean? So like you could do just as well buying a compounder at 10 billion market cap and it goes to 100 billion. And just as much as like, okay, you have $1 billion company or I know the stuff you look at, Fuhad, is like 10 million or 50 million to 500 million, right? It could be easier because that's a fallacy. It could be easier for the $10 billion company to get to the 100 billion in some cases than the 50 million get to the 500 million. Just because the number is smaller does not mean it's just as easy, because it depends on the company. So I would say that's a trap some people get stuck in. What you're ascribing to, I think it's just like, just focus on the company. If the company just so happens to be small and you know something and you're a big believer, good for you. Buy it. All right. If it's a bigger company and you really believe in it and you think there's a lot of potential in it, buy it. Good. Don't get trapped in the, but it's already a $10 billion company. It's only going to get to $100 billion. Oh, I want the $5 million company because that one's going to be a $500 billion company. Yeah, okay, maybe, I don't know, but it's a fallacy. I wouldn't get stuck on that. Favorite city in the United States? Okay, somewhat like a quiet by the water town. Savannah, Georgia is, I think, really pretty. New York, I'm giving you more than one because I can't choose one. New York City, obviously, for the hustle and bustle, all the food, all the things to do, if you're willing to spend the money. Yeah, that's where I'll give you two. One a little bit lesser known. One obviously everyone knows. Yeah. You said city. Oh, you thought I was Latina. I'm a female. That means I get certain privileges. All right. Well, you not say oil. I think long term there's a major underinvestment. Yes, absolutely. Okay, so there's a major underinvestment, but I think short term there's going to be pressure. Okay, I'll say one I like. I know that most people don't talk about it. This one is a smaller cap in Peru. I like Petrotal. I think you picking up. So there's some issues with it. Why it hasn't rallied as much as others, and it's on my watch list. But so I don't own it right now. For everyone listening, so if it jumps or not, I benefit nothing from mentioning it. In fact, I shouldn't have mentioned it because I don't want it to jump. I don't want more eyes on it. But I think like the risk profile politically is coming down a lot in Peru. And you're based off of the proven reserves and the potential reserves. There's a lot of value there that you're picking up for like $300 million, and it's well worth north of $1 billion. And they're gonna realize that value over the next 10 years. So it's fairly easy if you just do the proven reserves. That's not even the potential reserves, the proven reserves. It's about 1.2 some odd billion with previous prices, not the current prices, previous prices. The one problem with them is that they're not going to get to full ramped up production until end of this year. So the market didn't reward them too much, which is good. They have kind of a dumbass management team when it comes to capital returns sometimes. They're very obsessed with the dividend. They cut the dividend, thankfully, to focus on the CapEx. And their balance sheet's pretty shored up. They got a lot of cash, not a lot of debt. They put some leverage, but not a lot of leverage. They got more cash than debt, last I checked. And yeah, no, I think that one's interesting. No one really talks about that one on YouTube. So it's not really a well-known company. Again, no position in it. So it's the only problem with it, and why it's like tough to say I can own it, is liquidity. And then in like the majors, I mean, yeah, okay. I think I like Marathon Petroleum. You know, their management's solid. Diamondback Energy, solid. There's some of the royalty plays like BSM, still like net gas narrative. I think that's gonna still continue to do well. Tagra Resources for the pipelines. So all these ones I like. They're on my watch list. Right now, I'm just kind of weary about, with the whole everything that could kind of die down here. I think there's going to be potentially some negative pressure short term. But I agree with you. All the oil guys I've spoken to all say the same thing. So let's see. Still, what are the guidelines of what percent of your portfolio to allocate to a stock? No, I don't have rules. No, I don't have rules like that. I don't have like a maximum rule. I view it simply on like confidence. The higher the confidence I have, the more I'm going to put into it. The lower the confidence I have, the less I put in. So I'll be biased towards a company I know. Like, for example, let's say I pretend there's a universe where I know the return on a stock is 20% for this year. It's a fact. I will go crazy. I will buy up that stock like crazy, because my confidence. This is obviously a fake example, right? This doesn't happen, but my confidence is 100% somehow, and let's pretend the 100% is qualified by it actually happening 100% of the time. Do it all the time. 20% return, give it to me. I'll go crazy. Almost all my portfolio. Why not? I have a 10x potential stock. I have one big risk put into it. Don't be surprised if I put in single digits into it. It's not like, oh, it's 10x potential, all in. No, that's crazy. So yeah, I let that drive me. Would you consider deep diving next gen growth sectors, i.e., photonics, space, robotics? Are you familiar with any of the companies in this sector? So we had some folks in this who pitched light photonics, LITE, and Coherent. AOI was one actually we were involved in, and CRDO. But yeah, there's definitely a bubble in some of this stuff, right? I think in photonics, it's crazy. Yeah, I literally have some short puts on CRDO that's just like, I mean, it was almost like Instaprint, basically. Anyways, but yeah, those are hot potato stocks. Some of the stuff feels frothy there. I don't think looking for small caps is a fallacy. I think companies that are small have less eyes on them. No, yeah. I'll correct what I'm saying. The fallacy is that it's just because a company is small. That's what I mean by that. Because you understand, like Fuhad, he looks at like $50 million company sometimes. Like, just because a company is small does not mean it's going to return a lot. And just because the company is big does not mean it's going to not return a lot. That's what I mean by the fallacy. No, you're absolutely right. I'll give you an example. Dave has almost no coverage, no eyes on it. Look what it did when there was no eyeballs on it. I mean, it rose from $9 a share all the way to where it is, $230 a share. No one knew what Dave was. People are now knowing more about Dave, but that's an example. Another one, a former investment of mine, Northeast Bank. No one knows about Northeast Bank. Liquidity is like dog shit on that stock. No one covers that thing. It's a great business. No one knows about it. I'm not currently long right now. When we are currently long, Coastal Community Bank. No one knows about that bank. Small company, just over $1 billion. Wallix. No one knows about Wallix. I just talked about it. Absolutely. There's absolutely an opportunity, but Wallix won't do well because it's small. Wallix will do well because Wallix is growing. That's what I mean by the fallacy. But no, you're absolutely right that companies with no visibility, and we're not really, to be honest, like we're not going besides this, and it's not like this is going to get hundreds of thousands of views, blah blah blah, and everyone's going to know about these companies. No, I'm talking to what is like a closer knit community that at most these live streams get like a few thousand views. But we're not going out really in like a public square with a megaphone going like Wallix is $100+ million company. No, we're focused on the fundamentals, and they'll speak for themselves. If they just print money like crazy, that we'll get that return. I just talked about Petrotal. No one talks about Petrotal. No one. I think I mentioned Petrotal to a gentleman I had on a few times. Value degen, right? Small cap value degen on X, and I think he's talked about it, but really no one really talks about Petrotal. And it's a company that again, no position, so I don't benefit by talking about it, but it's frankly, like when you look at the assets it has, besides the political risk, which is real, but I think it's diminishing rapidly and people aren't noticing. You're picking up $1.2 billion for like $300 million, of course, discounted 10 years out backwards, right? Because it's not 1.2 million today, it's 1.2 million over time, and that's after tax and everything, by the way. So yeah. Oh man, you're just being super generous with the super chat. You didn't have a question with this one? That's just a thing to say thank you. Well, thank you for that, man. Favorite drink, Coke or Pepsi? You know what? I'm kind of a psychopath, so Pepsi, just slightly. Well, actually, neither. Dr. Pepper. Dr. Pepper. Vibe coding portfolio management level 3 never happened. Yeah. Okay. All of it plus smart. Yes, all of it plus margin with the other comment I remember. Can't keep the video on in the gym running from the treadmill because a dude wearing. Yeah, you don't want people to think differently, which is funny. It's like, I mean, you would see me at the gym and I'd be wearing this because that's where I'm going after this. I guess you can't watch videos with another dude wearing a tank top because then it's like you don't want people to think things of you. Who's Dave? Well, to continue off of this, Dave is our lover. It's our collective lover. No, it's a stock. I don't know if the question's serious or not. Hopefully Gil didn't actually short day. Yeah, I hope so either. I'm sorry, Dave. I'm afraid I can't do that. NBN, my TrustBN was so OP. LOL was done Fuhad diversification for the bussies. Fabio, how do you pick worst drink out of the two options? You mean Pepsi's the worst out of the two options? Yeah. Well, it's not by much. It doesn't win by much. It's texting people like Dr. Pepper. I didn't know you had such big guns hiding under there. Well, one of these days, maybe I can do. It's just like I do feel, unless I'm with a gym partner, I don't like to record things at the gym because I won't be that guy. But I do have some lifts that I think will be good to share. I'll share like some that I always tell people. It's like you could do something what I call the 5-minute challenge. That's more of a leg workout. So you take your body weight, put it on the bar, and then you put a timer in front of you for 5 minutes, and you squat, and you do as many as you can within that 5 minutes. Try your best not to put the bar down. You can, but if you do, okay, that's fine. But pick it up again until that 5-minute timer goes to 0. And you want to get above 30 reps. with your body weight. So I'm 225. So put 225 on the bar. I'm actually like literally right now at 225 flat. So it's super easy. Put it on the bar and you go squat, squat, squat. Try to keep your form, etc. Obviously, if you have a buddy or if you have, the rails and protection, because towards the end, it gets like you should be getting really weak in your legs. And then that's the 5-minute challenge, like we call it. And then there's a lunge one if you're interested. The lunge one's even worse. The lunge one's way worse. So the lunge one, you try to still go heavy. Heavier the better. But hopefully your gym has like a way where you can walk, because this is walking lunges. You want to get to a length where you're doing about 15 to 16 one way and then 15 to 16 back. So in total, 30 to 32 in one set. And so an exhibit, like, again, there's not really real proportionality. So I do this usually between 60 to 65 dumbbells. So per arm, 60, 65. And you go back and forth, hopefully with a partner, because this is where it gets hard. The easy one is the first one. And then the second one, you rest only 1 minute. After that 1 minute rest, this is horrible if you do it with a partner, because if you like take turns on this, because then they're like you can make it worse for yourself as they're your timer. But if you're just doing it by yourself, 1 minute. The second time, 2 minutes, or not 2 minutes, sorry, 1 minute 30 seconds. Then the third time, 2 minutes 30 seconds. Then the last one, the fourth one, before you do that one, you can rest for 4 minutes. So that one's way harder than the 5-minute challenge. Trust me. That one's way harder. And the last one I'll leave you guys is you can do, it's what's the name for it? It's called oh my God, I forgot the name for it. Well, I'll describe it and you guys will know what I'm talking about. You take if you can do a straight bar versus an easy bar, honestly, it doesn't matter. It depends on if you have bad wrists or whatever and it hurts you with the straight bar, don't do it. Just do the easy bar. But easy bar, again, as heavy as you can go. And you're going to do, it's more of a cardio exercise. You're going to do curls, then you're going to do rows, and then you flip it over. You're going to do shoulder presses, and then you put it on your shoulders again, but on the back. And then you're going to do squats, lunges, calf raises. Then you can put down the weight, and that's one set. And then you do 1 to 2 minute rest on those. You're going to be really out of breath actually by like the second or third set. And you want to try to hit 4 to 5 sets. So that one's really good. Really, really, really good. Like really tiring. The easy part should be the squatting side of it. So I do that with 135. And the 135 for squats, not that difficult. But by the time I'm getting there after doing the other stuff, because I would just be doing the shoulder right after, you're kind of dead. And so it makes the squats harder because you're already exerted yourself. That's why you start with the smaller muscle groups. You start arms, then back, and shoulders. The reason why you wouldn't do shoulders before back is because you have to get the weight up there. So it's just best, just knock out the back. And then if you want to make it a little easier, you can skip the back part, the rows, and you can just do from curls to shoulders, and then squats and the rest. But the leg ones, don't skip them. So yeah. Okay. But yeah, all that to be said, no one asked, but I if you guys are interested in that or want to talk about it. Yeah. Yeah, I'm always like hesitant to, I mean, I have some of you guys have seen at least like my benching videos. So I know that strongman, and some of you are telling me to do the push-up challenge, which I could do like, I guess 2 ones. I can do the Sally up challenge, and if you want me to do, I can just do like one that should do straight, however many I can do. But yeah. Okay. So I am bullish American LNG. Yes. Not I'm not long right now, but I am bullish American LNG because I think that the spot prices are going to match not match 1-to-1, but they're going to rise up to meet the international spot price. Oh, we're getting the fitness questions. Oh, we can do everything on this channel. We can talk about stocks. We can talk about macro, fitness, whatever, whatever we want. Mexican Coke. Mexican Coke is good. Software stocks. Is that in connection with something? Yes, but software stocks is good. Quantum still ripping after us? Yeah, Quantum, man. This shit goes, man. These shit goes. They won't die. They won't die. We get alpha advice on stocks and fitness. North Korean labor camps, except with food. I think Workday will survive Claude models. Oh, no, sorry, it's a question. Workday's pricing a little different. The HCMs look interesting. So like Paycom, Paylocity, ADP, etc. Because their seat count is more like the employee count. Yeah, I think Workday will survive. But you know, there's some of their products that will suffer some seat count reduction in HR. So yeah. Do you still wrist curls? Actually, I don't do wrist curls. So for forearms, I only do pull-ups and just everything else, and then just naturally just get the forearms. But yeah, no, I don't do wrist curls. Most of the besides like regular arm curls, most of the workouts I do are more compound workouts. So like even when I'm doing bench, I'm doing bench, right? So you're using multiple muscle groups. And then even when I start curling, when I use dumbbells for curls, I do a curl then shoulder press. So curl then shoulder press, which is really like, I guess for testing your mobility and strength to kind of get the dumbbell up there. And I guess one of these days maybe I can record myself doing it. But yeah, I'm just not gonna be one of those people that like comes with the whole like tripod. The whole tripod setup. Peptides are tests for what? Oh, you're saying if I take any? No, only creatine. And I'm not even consistent with creatine, to be honest. And I should be. But so the peptides conversations come out in when I was having dinner with some friends the other day, that apparently the new generation, they're just taking peptides. Like it's a pretty common thing now. Just pretty crazy. I'll tell you, if I was taking tests, maybe it would be easier to lose weight. Because that takes a while. I can tell you that. It takes a while. So it's easy to gain weight. It's hard to lose weight unless you use a little bit of some extra fluff. But yeah, I was like 235 not even too long ago. I'm 225 now. But yeah. Creatine is goated. But I'm still, even with that, like I'm somewhat consistent because I haven't taken any creatine today, which I should. I should remember to do that after this. But yeah, I'm just taking the standard 5 grams. I heard that, I guess like I'll ask the audience here, how much do you guys take? Because I take the standard 5 grams, like the normies think. Oh, great question. So I actually do not deadlift. I don't incorporate this at all in my workout. I am one of the only ones in my friend group who has not suffered a workout injury. And I used to deadlift, but I don't deadlift anymore. I decided it's like a workout for me that's just not worth it. I put maybe too much fear into it. So I just strictly stick to squats. For lower back, I just incorporate some isolatory workouts. And with lower back, I guess you could say I don't use a belt. when I squat, for example, I have this like strange rule. You might find it strange, but for me it works. I don't go above 225 or my body weight, because for the 5-minute challenge you do your body weight, but I don't go above my body weight on the squat. I just go for more reps. So I'm very conscious about longevity. Even with bench, I don't go above 225. I could easily go more than 225. On occasion, actually, that's a lie. Because on occasion, if I'm with someone and they're trying to like, it's like a sense of, you could say testosterone bravado. I'll go a little bit above with them, with the spotter, etc. But with bench, I generally don't go above 225. I focus on repetitions, and yeah, that's it. So longevity on everything. So that's my way of thinking about it. I know that some people like swear by deadlifts, and what I'm saying is sacrilege, and they're like, "How dare you?" My brother deadlifts, and he likes it. But for me, I'm just like, well, I'll be fine without them, and I'm maybe a little too paranoid about any injury. Maybe stop being a bussy. Makes you strong like bull. Yeah. Well, I do other things I think help out with like in the strength department. Like I say, I mean, I can squat for a lot of repetitions. The lunges, I think I do pretty heavy on lunges. I can do what they call farmer walks, like just carrying weight, just walking. Is it farmer walks? But yeah. So stop being a bussy. Yeah, deadlifts ruin my lower. So that's what I'm worried about, deadlifting and ruining my lower back, or ruining any part of my back. I don't want any of that. So I'm confident with just like with 225 with squats, I can dominate that weight, and I'm comfortable with like the forms, etc. My buddy was fucking up his shoulder benching, like, but that's because he was just stubborn in doing 225. And he wasn't watching his form. Also kind of my fault, because later I got strict on him, but he only after he told me about him feeling pain here, because constantly just ignoring the pain that you're getting and just doing it anyways, he wore out some of his shoulder, and so he had to take a break for a while. But yeah, just like how form is important for injury avoidance. But even he injured himself. He has a chronic dislocator on his knees, so that's a bit of a problem. So yeah. Oh no, I do RDLs. Yes, I do RDLs. I get also some elevation. So for some lower back, I get some elevation, and I'll do straight legs, and take a nice heavy dumbbell, like 70, 80 pounds, and then just kind of get a nice stretch going. Try to go, if you can, beyond your toes. Gets a really nice stretch, and then come back up. Really nice stretch, and get back up. So I do not take any pre-workout, actually. So no, I'm literally creatine and protein. Creatine and protein. Yeah. So it's funny that we said that, because I literally just got I had my doctor's appointment, and I literally just had the blood work done for my yearly checkup. And you know how you always have to tell them, yeah, I take creatine, because then it shows up in like your test. But yeah, because they'll panic on like your kidneys. They're like, oh my gosh, what is this? But yeah, no, just creatine, protein, and it's only 5 grams of creatine, and protein, I don't know how much. I'm bad at that. You see, I don't even keep track. I might consume my body weight in grams of protein. I don't know. I just eat chicken, meat, steak, fish, protein powder. I have protein shakes, the Fairlife protein shakes. But yeah. Why didn't I buy Allbirds yesterday? Oh, because I'm a fucking idiot. That's why. Fabio, you're not look maxing hard enough. Yeah, my cortisol just spiked because you said that. Anyone buying stretch? I've never heard of this stretch. What is a stretch? It's not even a real stock. Yeah, it's not a real stock. Bro, having gnarly what? How do you know? Long Fairlife. Fairlife's owned by Coke. Owned by Coca-Cola. Fun fact. So you just go long Coca-Cola. No, Fairlife is goated. The Fairlife protein shakes, amazing. You get the 42 gram protein shakes. Oh. Stretch from Sailor. Oh, it's real. What? You serious? Which one is it? Is it this one? I have no idea. If you told me I should stop drinking that, maybe I should stop drinking that. Oh, the preferred stock. Fuck no, I'm not touching this. Well, I won't say I'm not touching it. I don't know. I'm instinctually not going to touch this. There's probably something to it. I don't know. Bird performance is mogging us. Yes. It's clownery, I've heard. Yeah, probably instinctually. You tell me, oh, anything MicroStrategy, I think, probably a clown thing. It's 11% returns. Oh, is that the dividend? STRC Voidzilla, just do a video about it. Oh, just did a video about it. Oh, okay. Maybe I'll watch it while I'm, at the gym today. I don't know about you guys, but sometimes I'm like a little psychopath at the gym. I know that one of you said that you can't have me on at the gym. Was it you, J3FF100? You can't have me on at the gym because I'm in a tank top. They'll think differently of you. But yeah, I also listen to some dude talking while I'm at the gym sometimes. I don't know. It just pumps me, just hearing a man talk in my voice, not in my voice, in my ear. I don't know if you guys can relate to that. Just like, I don't know if one of you out there is lifting right now and I'm just giving you motivation. I'm just like going, hey, we're talking about stocks, 11% dividend yield. Going long, going short, all of the above. Brother, just listen to music. No, I listen to music most of the time. If I'm really locked, obviously, like when I'm doing those challenges I told you guys about, I'm not listening to some dude talk. But it's usually in the lighter parts of the workout. I might too, because I don't have infinite time throughout the day, so I actually will get through an earnings call maybe or two. But yeah. All right, so Dex, I just made Dex goon. Turn an ASMR, just start clicking things. So I go. You guys make me laugh, or you guys make me make myself ridiculous jokes. Yeah, exactly. During a treadmill, because the treadmill, I dread it as well, or Stairmaster or anything like that. It's like, bro, just someone fucking talk to me. Someone talk to me, and then you have like you look at it's a 30-minute video, and you're like, okay, I'm gonna do it for 30 minutes. It's the length of this video. That's my timer. This affirmation session. Yeah. Well, yeah, I'll try to. I always wanted to, do that, and maybe it encourages other people in like CM to do it, but just like record workouts and stuff. Because I like seeing other new, unique. Everyone has like some unique workout. A lot of the workouts that I just told you were people who just came up with it and told me about it. Of course, anyone can come up with any workout, but yeah, I bet all of you guys have like unique workouts that I'm not incorporating, and I should probably incorporate some crazy shit. I don't know. One of you is like, yeah, you do this, and then you can get your lateral raised to 135. some crazy. But yeah, ASMR channel. Oh yeah, we can do an ASMR channel. Absolutely. All right. So if there's any last minute questions, I'm happy to answer them. Otherwise, we're going on 3 hours. So enjoy these live streams with you guys. But if not, if there's no more questions, which I'm happy to get into, we'll close it off here. So I'll stay like a couple minutes. See, I think I answered most questions, if not all the questions. Well, while I'm waiting for those questions, I'll kind of give Blue Bell. Oh, I don't have it in front of me. So you know what I have? I do have one sort of like gimmick decoration. I have the really heavy mug, and you can curl with that, and you just do curl for tons of reps, and you actually get sore. Any thoughts on Novo Nordisk? Oh man. Oh, yeah. So how that peptide conversation got brought up at the dinner I just mentioned was we were talking because one of the people at the dinner was started using the pill from Novo, Wegovy, the Wegovy pill. And no, it's like, I mean, anecdotally, it's being used a lot, right? So one person at the table was using it, and they were saying that everyone they know is on it. It's word of mouth. I'm assuming the data looks like it. I know that Novo Nordisk has been cratering, but the pill format seems to be very popular. I have to look. I don't know if they're the only one that does it right now, but yeah. So that's my thoughts. Eli Lilly right now, like it appears as though their alternative, which is Manjaro, seems to have a bit more effectiveness, a bit more potency to it. So there's the thing, but it's priced for it. It's priced for it. When you buying LLY, I'm not buying pharmaceuticals. I don't belong in that space. Ask Biotechs. Biotechs is the guy to ask. PharmaShell, as he's known publicly by the public. Ask Dr. Latina about the Netflix bull call flow. Oh, this man's holding out on me. Dr. Latina, if you're listening to me, you didn't show me this. All right. So with that being said, summary on everything we talked about today. The Iran conflict. I think we know now it's becoming more and more clear that the whole Iran holds all the cards, the US is fucked, all that's completely bullshit or exaggerated. I think there's lots of reasons to be bullish still. I'm not a perma bull. I do get bearish sometimes, but everything we're seeing with the economic data that can change suddenly, but what we're seeing with the economic data implies that I think we're headed for good things, not bad things. I think that the risk profile of Taiwan has come down drastically. I think that the consumer still looks really strong from the bank earnings we've had so far. I didn't even talk about that. JP Morgan reported and a few others. So consumer still looks really strong. I think the fintech rally, while very violent, is also because it's been suppressed for so long. It could pull back here. It could have a little bit of a course correction. We will have TSM reporting here soon. Since the next time we see each other, we will talk about that. And we're going to see, well, we didn't talk about ASML reporting, but ASML reported fairly good numbers, but the valuation is what's kind of maybe holding it back. And I think that the best setups here is in that same ownership of infrastructure for this compute, which I think are going to have margin expansion in the near future. Is software bottomed? I don't know the answer to that. The answer, I think, is nuanced. I don't think software really presents this I must buy, put 20% in opportunity yet for some of them. But they might get there. I think that software was just insanely overvalued and got back to a level that it's now either fair value and in some of them undervalued. But that doesn't mean that the undervalued can't get even more undervalued, because some of them really will suffer from the changes that are occurring. And in their death cries, they might make other investors scared of the ones that will survive and will benefit. And I will say many of those companies that might not survive, a lot of them aren't even public. But even if that's the case, if you get news that they're dying, that still won't bode well for the public market. Public markets, when they get spooked, they tend to stay spooked for a while, so more than you think. But the rally we're seeing, if we see strength into the announcements from Anthropic, from these other LLM companies or LLM firms, and we don't see a retracement in software, maybe that's your argument right there, the sign that we bottomed, and you might not get the best price possible on the software name, but you're getting, I think, fair prices. So that's why I do have long positions in some of the software names we talked about today. But to reiterate in the summary, I think that if you're buying them, you have to buy them with the idea that they're gonna maybe go lower. They are not, in my view, at a level where you say easy buy, there's no risk, 20% position tomorrow. Only that very good companies at fair prices, sometimes that's just good enough, and it still could produce outsized market returns. And yes, so I already disclosed when we talked about the individual stocks, which stocks I'm long, which stocks I'm not long. And again, as a reminder, down below is where my sponsors are. So if you want to support the channel in a different way, there's the club where you can have access to me to talk, and I do private content and the like. And then also you can support me if you're interested in using FinChat's products. The sponsor link is down below. Everything I expressed in this live stream is my own opinion, does not necessarily express the opinions of Fraxinus Capital. We got a super chat. So I got, do you think Steam open source, their software, royalty-free gaming dev software engine will hurt Unity and Unreal? Oh, yes, it could. Oh, yes, it could. Yes, definitely. It's a new entrant. You can't really invest in Unreal. You can invest in Unity, and Unity already has some bad reputation, I should say. They scorned a lot of their developers, so it presents an opportunity for Steam to take market share there, where otherwise they might not have been able to. So that's a problem. So no, great question, and yes, and I'm cheering for Steam. Valve is a good company that's not public that everyone wishes they could own. If it went public at any point in time in the future, oh my god, the premium would be insane. But yeah, no. I do think it's a threat. I think it strengthens their ecosystem a lot, and I see what Steam's doing. I think Steam's building something very interesting. So Valve is getting sued from all fronts. I mean, yeah, it's a threat. Okay. Questions are coming in last minute. Would you buy OpenAI if they IPO? Depends on the price. I'm not adverse to it. I think a lot of people are too negative on some of these companies, saying that they're not making money. I've already broken down before, like why the unprofitability argument is like greatly exaggerated. It's like, do you not remember Uber? Do you not remember all these other companies that were even worse on a relative scale? So OpenAI or Anthropic, there's a price I'd pay. It's just I don't want to pay, nosebleed valuations relative to their future growth. I don't care about high multiples. I just care high multiple relative to the growth. So yeah. Would I buy it if they IPO? Maybe after the IPO at some point. Unless the IPO price I think is extremely undervalued, which tends to not be the case. So most likely not. By the people. All right. With that being said, guys, thank you guys so much for joining me here tonight. I really enjoyed this live stream with you guys. We're 3 hours and 30 minutes. As you can see, I definitely enjoyed it. And if you guys enjoyed it, feel free to leave a like, share, subscribe, comment, do whatever it is on any of the platforms. And I will see you guys on the next one.